I think it's very hard to make a bullish case right now.
We really don't know what's going to happen, but we also obviously see that there's a lot more vol in the markets.
As long as the dollar and yields continue to move upward, investors need to brace themselves for more pain.
Some of this volatility is really a reaction function to that problem the central banks are having.
It seems like central bankers are willing to push things as much as possible, but not at the risk of financial stability.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
Congratulations, you made it to the end of the third quarter. And you have another 3 months to go. Live from New York City this morning. Good morning for our audience worldwide. This is Bloomberg Surveillance on TV and radio alongside Tom Keene and Lisa Abramowicz. I'm Jonathan Ferro. Equity futures positive 0.7%. TK and Gage, get your head up. Let's go. Another messy quarter behind us.
It's a messy quarter. I saw Gideon Rose yesterday at lunch, John, the Acts of Foreign Affairs magazine. I said 2022 was his fault. And, John, I look where we are, and this derivative story in the United Kingdom is absolutely front and center for global Wall Street. Focus. The Bloomberg Financial Conditions Index for the United Kingdom has not reversed. It's moving down this morning to new levels of restriction for the nation.
Lisa, we've got a lot of problems to deal with, not just for the UK, but for the global economy as well, and for global markets. 3 straight quarters of negative returns on the S&P 500. I didn't realize this. You have to go all the way back to 2009 to see a streak that bad.
And you have to go back to forever to see a streak that bad when it comes to the bond losses. So the flip side is there's no place to hide, right? So stocks are selling off, and the nature of that sell-off is continuing to change. Just overnight, we got a number of earnings. We have had downward revisions to some of the earnings expectations by Wall Street analysts. They have not gone far enough. That was the message from earnings that we got last night. And going forward, the earnings are going to be front and focus.
Mr. Hartner over at Bank of America, almost on the edge of constructive about 2023. I'm going to come back to that note in just a moment. I'm going to whip through the price action. Elisa's going to go through the day ahead in just a moment. Futures are positive by 0.7% on the S&P. On the Nasdaq 100 up 6 or 0.7% also. So can we get a strong finish to a pretty rough, messy, volatile third quarter? Yields lower by 9 basis points on a US 10-year, 369. Lisa, what a range we've seen in the global bond market this week.
How much has been driven by the United Kingdom and what happened with the budget that was proposed and the violent reaction in markets today? We do get perhaps some kind of fiscal response, and we have seen the pound really ratchet back some of the losses and regain some territory versus the dollar in expectation for possibly some change of tone. Prime Minister Liz Truss and Chancellor Kwasi Kwarteng are holding emergency talks with the head of the Office for Budget Responsibility. They had postponed the report from OBR, basically saying there were other aspects of the proposal they were not willing to release yet. Now, are they going to backtrack on this? Regardless, people are getting a little more optimistic that perhaps the worst case scenario will not pass with cable at 111. Meanwhile, today, August U.S. personal spending and income data is core PCE deflator. All this U.S. data, that is coming out at 8:30 a.m. and University of Michigan Sentiment Survey at 10 a.m. Core PCE deflator. This is the Fed's favorite metric to look at to get some sort of sense of the trajectory, especially at a time when this is the area that probably may be the stickiest going forward. Right now, we are expecting a little bit of a stasis there, but especially with the Eurozone, seeing 10% inflation for the first time. We just got those numbers this morning. It just sort of shows you how difficult of a problem, how intractable this is. And at 11:30 a.m., President Biden is delivering remarks on Hurricane Ian recovery efforts. It's been just devastation, John, and it's going to cause a huge recovery effort, the likes of which will probably cost somewhere between $69 and $100 billion.
Lisa, thank you. We're going to return to that in a moment. A little bit later this morning, we'll catch up with Anne-Marie Hordern. Tom, I wanted to start with a poll over in the UK from YouGov. Labour with a 33-point lead over the ruling Conservatives. This has been described by YouGov, Tom, as the biggest lead enjoyed by any party with any polling company since at least the late 1990s. That is big.
John, I took all the little itty-bitty parties out, and I took the Liberal Democrats over to Labour because I guess they're not conservative, and it's stunning the gap between Labour plus LDI and the Tories.
Unreal. Joining us now, Andrew Griffith, the UK Financial Secretary to the Treasury and the City Minister. Andrew, fantastic to catch up with you, sir. We understand the Chancellor, the Prime Minister, is meeting with the OBR today. The Bank of England's gilt market operation ends in the middle of October. Should those forecasts from the OBR be published before then?
Well, the key thing to take away is that the government the OBR and the Bank of England are all working in a coordinated fashion, each doing their respective jobs. So the bank's doing its job on monetary policy and market conduct. The OBR, its job on forecasts and bringing forward the forecasts when they're ready to be able to wrap in the recently announced government growth plan. And then, of course, the government growth plan, which has features about energy, protecting households and businesses, how we're going to go forward on energy security, building clean energy going forward, and also a lot of supply side measures in the UK. It's a very growth orientated plan. So what you've seen over the last week is each of those players do their job. It's good that the Chancellor and the Prime Minister are joined up with the OBR. I think that meeting finishes shortly. But you've seen a lot of coordinated activity over the last week.
Andrew, I haven't seen coordinated action at all. I've seen a mess. I saw you come out last week with a mini budget. The Bank of England follow up with unprecedented intervention in the gilt market, and the OBR. Now you visit the OBR and look for some forecasts after the fact. Why weren't these forecasts published alongside this mini budget last week?
Because the growth plan's got lots of components to it. There was an imperative to act this time last week. It's tomorrow. This is the quarter end. It's tomorrow that energy prices would have gone up across the United Kingdom. Real uncertainty for businesses and households. So it was right to do that then. There's a lot of detail in terms of how the UK government wants to see growth going forward. And that wouldn't have been available to the OBR to factor into their forecast. Indeed, some of that we're still waiting to announce over the coming weeks, plans for infrastructure, for the housing market, for childcare, some of the deep-seated challenges that probably all of our major economies have with growth. So, look, it's been a busy week, but each of those players are doing their job in a coordinated fashion.
How concerned are you about the increase in borrowing costs, with some people citing a 10.5% mortgage cost at a time when the Bank of England is being tasked with offsetting a proposal that has not been put out there, but the market is responding?
Yeah, look, of course, rising rates are a concern. We've seen that obviously, going into last week. I think you'd seen more tightening in the US. That's now happened in the UK as well. We've seen figures out of Europe as well today indicating that they've got exactly the same sort of issues around inflation. What the energy package measures do is actually reduce the headline rate of inflation. And that's something that's going the other way to the trend we're all seeing.
But Andrew, there is this discussion about not releasing the OBR report earlier than the November 23rd deadline at a time when the market's moving. It's having real-term effects now. Why not just release it earlier to give people a sense of what's going on?
Yeah, well, Lisa, look, I was a finance director for 11 years. My board wanted me to release my figures as early as I could. But they also wanted them to be credible, to take the time to reflect all the information in a very fast-moving world that's available. So everyone will have their own view on that. I think you just have to recognise there is a balance between speed and velocity and being able to wrap in information. And some of that information, as I say, will be coming forward. The growth plan itself is a 40-page document, and some of that detail will still be released over the coming weeks.
Andrew, it's not for you to decide how long the OBR needs, is it? Let's get real about this. We're reporting now that you haven't sought to accelerate the watchdog's eco forecast at all. That's our latest report, according to officials familiar with the comments after the OBR Treasury meeting. Why haven't you asked them to accelerate it?
Well, I've talked about how there's a lot of different detail. I don't know how familiar you are with all of the growth plan. People have heard some of the headline measures. They've been widely reported, perhaps less so about the plan for infrastructure, the plan for immigration, housing, these elements, really important elements of the growth plan. That is how we're going to finance the fiscal announcements that were made last Friday. So I think you've just got to look at it as a package. When the Chancellor asked the OBR to report on the 23rd of November, it was in contemplation of being able to take into account the whole of that package.
Have you asked the OBR? Have you asked the OBR to bring forward those forecasts as soon as possible, or have you told them that you want them at the end of November?
Well, the Chancellor will read out on his meeting in due course. But in the meantime, don't lose sight of the fact that the fundamentals here were strong coming in. We started this with some of the lowest debt to GDP in the G7. The economy is still growing, albeit we acknowledge that there's challenging headwinds.
Andrew, Tom Keene in New York. I'm sorry to bother you. As we speak, the Bloomberg Financial Conditions Index for the United Kingdom is a -4 standard deviations. You have seen a 7 standard deviation move in the blended gilt price move. You have a derivative disaster. You are the city minister. What are the regulators going to do finally to amend the derivative shell game that caused the Bank of England to bail out the marketing industry of LDI?
Yeah, and you'll be aware, Tom, about the independence of the regulator. So one of the things that you learn as city minister is that the regulators have their job to do. What my job is to make sure that we have the most competitive environment in which to do business, Tom.
Okay, you have a competitive environment that on a 7 standard deviation move blew up. Fine. What does the United Kingdom do off of the scandals of 2007 and 2008 to finally control the natural greed of the derivative business? You're at the heart of this as city minister. How do we finally get our every 8-year derivative blow up fixed?
Well, the Bank of England is taking the actions that they need to in the market right now. In the long term, of course, we look at getting the right regulatory structure, and that's a shared objective of ourselves and the bank and the prudential regulators. So, of course, one will always look at wherever there are other points in the regulatory structure that need to be looked at. But that's not the focus for today. The bank's made its judgment and its interpretation of the markets. The thing to your point earlier, Tom, in terms of the politics, is that we need to communicate how this country is going to grow. That's what's going to give people the confidence to invest, the confidence to hold the currency, and the ability for us as government to fund the high quality services and all of the infrastructure that we need.
To Mr. Ferro's questions earlier, what do you need to do on this Friday evening to give confidence Monday that the different experts are advising the Truss government of the outcomes of their Reaganomics-like policy?
Well, I wouldn't accept that characterization. What you need to know and the markets need to understand is that we are working absolutely in lockstep. You've seen a number of coordinated announcements from both the government and the Governor of the Bank of England over the course of this week. I spend my time meeting investors, talking to regulators, talking to the financial markets. But these are volatile times. And we're seeing that in every market. Sometimes at different speeds and pace, but it's a macro trend that we're seeing. And some of the things that we are tasked to do is to bring forward supply side reforms to improve the UK's energy security situation, because the aberrant here is the strength of the US economy, the strength of the US dollar as a function of your greater energy security.
Wait, it's our fault.
We can't fix that one overnight.
I just want to make this clear, John. I believe the minister just told us it's our fault the UK's blown up. I think that's what I heard.
Well, we don't have time.
No, that is not what you heard. What you heard is that we've got a job to do to try and improve our energy security. And if anyone thinks that this isn't ultimately a macro issue that flows in part from Putin's invasion of Ukraine.
Andrew, I've got seconds on the clock. If you can just wait there, we'll come back to you. This is Bloomberg.
Navigating the economy toward a more sustainable path necessitates higher interest rates and a downshift in the pace of economic activity and the labor market. But for now, inducing a deep recession, the kind we had back in the 1980s, or some would even think of the Great Recession, that is not warranted.
That was Mary Daly, the San Francisco Fed president, speaking just yesterday. Live from New York City, this is Bloomberg. Moments ago, we caught up with Andrew Griffith, the UK Financial Secretary to the Treasury and City Minister. We bumped up against what is called in the TV business a hard break, a commercial break that was set to begin seconds away. And unfortunately, he couldn't complete his thoughts. The City Minister had to go, and hopefully we'll get him back soon.
John,
well, hopefully we can get him back soon and we can wrap up his thoughts,
but
Tom,
your
another
comments
time.
on this, John, were absolutely timely. And what I got there, John, was a complete lack of urgency of the moment when I still see, I know pounds recovered, but there seems to be a complete understanding by the British government of the urgency here within global Wall Street.
What they're first trying to address, and what was clear from that interview, is they're trying to address the optics here. Come across as a united front, coordinated between them, the independent body that provides the forecast, and the Bank of England. That's not how it played out over the last week. Typically, if you had a budget announcement, alongside that budget announcement would be some independent forecasts from the Office of Budget Responsibility. That didn't happen this time around. Then what would happen, obviously, is that the Bank of England would meet November 3rd and they'd provide you with some new projections and monetary policy. Of course, that's not what happened either. There was nothing coordinated about this. It was messy. So what's happened is you got the budget, then you had the massive market fallout, an unprecedented gilt market intervention from the Bank of England, and only now is the Chancellor and the Prime Minister meeting with the OBR today. And it's still not clear to me when we actually get those forecasts. The OBR confirming just now they're preparing the forecast for November 23rd to go along with the fiscal statement. So, Lisa, here's the timeline now. October 14th, the gilt market operation ends. November 3rd, we have a Bank of England rate decision. Then all the way out onto November 23rd, we have a fiscal statement. That's a long runway, given how quickly this market's been moving.
Especially because the Bank of England has to respond, and that's what the market has told them. That's clear from their intervention this week. If they raise rates in the meantime, they cause real pain, they cause real changes in the spending habits of households at a time when all the details aren't out. Is that the policy that they had intended?
Futures right now up 0.8% on the S&P. Can we get a strong finish, Tom, to a messy third quarter?
A messy third quarter, and we'll continue this discussion on that shocking interview with the finance minister and the city minister of London. Chris Marenghi joins us right now. He's observing Britain. He's observing these crises from a prism of value, equity, investment. How's your study of the British economy going, Chris Marenghi? How do you pull this global Wall Street tumult, clearly what is a massive derivatives failure, how do you pull it over to conventional Gabelli investing?
Well, it's just we're certainly learning a lot more about LDI and how this all works. It's another micro input into another macro input into our micro forecasts for companies. We're overlaying currency moves and what that impact might be on revenue and costs for all of our companies.
Do equities in the United Kingdom enjoy the repricing and value that we see in gilts?
There are certainly some bargains throughout Europe. It's probably too early for us to do much there, but we're looking for companies that, in some cases, the UK companies that are selling abroad and are benefiting from their price competitiveness given the movement in the pound. One of those would be, for example, Diageo, which sells a product that is not going to go out of style anytime soon. You probably drank it last night. We'll drink it certainly tonight, and that looks like it's increasingly interesting.
As you watch the fast-moving picture internationally in the UK and in Europe as well as China, how much do you think has actually been factored into U.S. multinational companies and their earnings, not only from the strong dollar, but from the deterioration in the backdrop in some of these other regions where they export to?
Yeah, I don't think it's obviously this is not the first time we've seen these kind of movements, and they never seem to be fully priced in. We thought we'd see a lot more earnings weakness in the second quarter. That turned out not to be the case. The U.S. consumer in particular was more resilient than we thought. We're bracing for some pre-announcements and earnings cuts as we begin to report the third quarter in the next couple of weeks. So we'll see. Obviously, that's an important factor, along with the overall multiple, which we're still trying to determine for the market.
So everyone's pretty bearish right now. Are you a bull?
I would say I am a chastened bull. We think that listen, we've been through this before, 07, 08. I don't want to echo Larry Summers' view that this feels like 07, although there are some similarities. But I think if you held on through that period, we did quite well in the equity markets. We did well relative to other strategies. It's about finding the right business models, the right balance sheets, and the right managements to make it through to the other side, and that's what we try to continue to do every day.
Chris, Great to catch up, as always, sir. Sorry it's on the short side. Chris Marangi there of Gabelli Funds on the equity market at the moment. Mr. Hartnett over at Bank of America, bearish all year, put out a note this morning that said the following. The big low's not until Q1, when the recession credit shocks equal peak Fed and peak yields and peak US dollar. The trader 23. How's this for constructive for next year? Short the dollar, long EM, small cap and cyclicals. What do you make of that, Lisa, this morning from Bank of America and the team?
It makes sense. To be completely honest, it makes sense, because if you believe that things are moving as quickly as some of the earnings seem to suggest, as some of the peripheral data, that more sort of granular data seem to suggest, then if we get a pause, if we get some sort of downturn next year, you can start to expect and price forward the recovery, which might be what they're looking for. And I think other people are looking for this too, right? Mike Wilson was talking about where we are in the different economic cycles, the stock market as a forward-looking instrument. So we're looking forward to 2024, which potentially could be better than 2023.
John, here's a precursor, what Chris Marangi just brought up. He mentioned Diageo, the huge liquor complex of the United Kingdom. In sterling from a high, it's down 6%. In dollars from a high, it's down 23%. That shows the distortions we've got upcoming starting October 14th.
It's been a crazy time.
Yeah.
Before we even get to next month, we've got to reflect on the amount of intervention we had in the last couple of months. I would argue we started with the ECB, at least earlier in the summer, when they were facing down the prospect of hiking interest rates and at the same time had to do something about containing bond yields. We're seeing that play out in the UK in a much bigger way this week. The BOJ's had to come in and intervene in the FX market. China's threatening to do the same. And I think we've got to almost restart and think about what this tightening cycle is going to look like. Does it involve QT? Will it actually involve QT?
Or perversely, will it involve quantitative easing?
Exactly.
Will it perversely actually lead to central banks buying bonds of certain denominations while trying to hike rates? The difference, and this I think has become the distinction over the past few weeks, we have shifted from tightening into pain, tightening into a weaker economic cycle, to trying to spend, to do fiscal spending in order to support households while also tightening to combat inflation. We see this in Germany with that 200 billion euro plan that they put out there for energy prices. This is the tension emerging into the fourth quarter, and it is a tough one.
And policies in conflict all over the place. That's been a theme of this programme, that's for sure, so far this month. Futures bouncing back up 0.8% on the S&P. Yields are lower by almost 10 basis points. We were through 4% earlier this week. We're at 369. This is Bloomberg. What a quarter it's been. Live from New York City. Good morning to you. Equity futures bouncing back by 0.9% on the S&P. Coming into Friday, we were poised for a third straight quarterly loss. For a streak that bad, you've got to go all the way back to 2009. Yes, it has been that long. In the bond market, yields all over the place. We've talked about the range this week, through 4% briefly, back down to 368. Yields lower today by 10 basis points, 368.42 on a US 10-year. And talk about ranges. Cable in the last week or so. We can put up a monthly chart, but I can tell you where we've been on the last week. 103.50 Monday morning, all-time low in the Asia session. Right now, 110.95, and a higher session today, 112.34. That is a major currency against the dollar. Tom, have you ever seen a range that wide in a single week? 103.50 out to 112?
And yours and my word for the weekend is febrile, and that's what I see here. John, what amazes me is how all the other data does not correlate with a quote-unquote pound sterling rebound is being reported by the financial media. Just in the last 10 minutes, granted, it's rolled over a little bit. I get that. But I'm looking at all the other data out there in the Bloomberg, and it does not correlate with crisis over for the minister that we just spoke to or for his prime minister.
We've got a Band-Aid on things right now.
That's well said.
Lisa,
That's
a Band-Aid.
Right. Yeah.
And Lisa, by the time we get to the middle of October, people are describing that moment as a cliff edge. We had the Bank of England come out early this week, announce a gilt market operation that is targeted and limited. It's limited in time to October the 14th, the middle of October. Then their next move on the monetary policy side is early November. And I just wonder what happens to happen between now and then.
And what does the threat to financial stability look like? Yes, we saw the issue with some of the long-dated investment plans for pensions and what happened there. But on a bigger scale, we haven't seen a buyer strike. does a buyer start to reassert itself, particularly in the debt markets, as big nations try to finance fiscal spending through debt markets that are changed? This is a new dynamic.
I know you think of Germany out with a massive package in the last 24 hours. Tom, double-digit inflation in the Eurozone.
Yes, yeah, it got buried yesterday.
Double digits.
You brought that up. That was at 8 o'clock yesterday. John, that got buried. And, I mean, culturally, that's just unimaginable.
It's happening. It's the reality of things.
In Germany, Christian Schulz joins us. He's Deputy Chief European Economist at Citigroup. Christian, completely out of your remit, but I got to ask, and particularly I have to ask before you and I read the financial stability volume from the International Monetary Fund, which will be published here in a matter of weeks. Does Citigroup feel that Europe has the financial derivatives risks of the United Kingdom and even what's being alluded to in the United States? When you've got Dutch schemes doing derivative strategies and even German schemes, is this a risk to Madame Lagarde that we will see a derivatives blow up on the continent?
Well, the European Systemic Risk Board yesterday issued for the first time in its existence, which admittedly isn't very long, it was created after the 2008-2009 crisis, but it for the first time issued a general warning. It is really general if you read it, but it's pretty clear that we are worried that there's pockets like just been identified in the UK and the LDIs in various parts of financial markets and beyond in Europe, right? Especially, for instance, in energy derivatives markets, we know that there's issues, but also in bond markets, equity markets, everywhere. It clearly is a big risk. Volatility poses a major risk, and central banks have to be aware of that.
How does that change the prism for the ECB launching to their meeting the end of October?
I think the October meeting is fairly safe. I think the risk, because the ECB is going to hike interest rates, the question is whether they're going to go 50 or 75. Gradualism, I think, is back in fashion now. If you want to prevent major volatility, you better act gradually. So going for 100 basis points or talking about QT already, I think that becomes less likely. Reliability or a steady hand is more needed. But also big shifts in the dovish direction, I think, don't make much sense if governments come out and support the economy in a massive way. So I think 75 basis points is a good call for the October meeting.
Perhaps that's the short term, Christian, but how much are you ratcheting up your longer term inflation forecasts for Europe in general based on some of the spending that they're doing to support households now, which are going to kind of counteract potentially some of the inflation combating of the central banks?
Well, the funny thing is in the short run, they will lower headline inflation, right? These price caps are going to reduce inflation perhaps by 2 percentage points in Germany or 0.5 percentage points in the euro area. As a whole, and in the UK, they're lobbing off, 5-6 percentage points off inflation with these price caps. But this is an illusion, right? Because what these things do is they increase the demand for energy and therefore increase wholesale prices. And somebody's eventually going to have to pay for that. You can't securitize all of this. It is going to lead to higher inflation down the line. So what we're heading for, I think, is lower peaks in inflation, perhaps, or somewhat lower inflation next year, but higher inflation for longer, above target inflation for longer. And that indeed, as you rightly say, poses a challenge to central banks, a credibility challenge to central banks.
Well, just to put some numbers on it, to give a sense of the scope here, are you talking about, for example, 2.5% inflation in the euro region until 2025? Or are we talking about 4% inflation through 2030, right? There is a difference of magnitude when we talk about a stickiness here for a longer period of time.
Well, we're still heading for some kind of recession in Europe. That recession may now be somewhat milder if all this fiscal support comes in, but it may also be harder because of all the financial tightening that central banks are driving at the moment. I still think there is a prospect whereby underlying inflation, say core inflation, gets in 2024, 2025 back to target, and where the central bank can, in a controlled way, sit this out. They have to hike, but they don't have to hike massively beyond neutral. The risk is that inflation expectations de-anchor. That risk is effectively a little bit reduced by these price caps because they reduce spot inflation, and therefore, the risk that households adjust their inflation expectations to that and raise raise wage growth, for example. But that risk you cannot dismiss, and people will see, of course, that if they use more gas because of these caps, the wholesale prices will go up, and sooner or later they have to pay for that. So the question is, what is driving inflation expectations? Is it spot inflation, or is it a general sort of trickiness about institutional credibility, which I think is increasingly the risk?
Christian, you go to the heart of the matter brilliantly. And this is the difference between, I'm going to call it continental or Germanic economics timeline in the United States. You're suggesting banks, central banks, can amend out and wait 3 or 4 years with patience and with stable policy, where in a technocratic United States, they're trying to fix it in 2 meetings. Is the x-axis of the United States Central Bank flawed for you? Is Germany and ECB, are they doing it more correct?
I think the US has a more straightforward problem to resolve. I think there is excess demand. The economy is overheating, and the Fed has to regulate it down. Of course, the government could help them, but the Fed knows what it has to do even without the government. I think the ECB has the problem that they can't fix this problem on their own, or if they try to fix it on their own, they're going to make the problem worse. They need the support of governments. Governments are the ones that can raise supply or can help raise supply of energy and therefore lift supply overall and bring inflation down. And governments need some support for that. Governments need stable financing costs. They don't need low financing costs, but predictably stable financing costs. So in an ideal world, the central bank and the government would talk to each other. The governments would do things that support supply, not that boost demand into a supply crisis, and the central bank would move in a gradual, in a controlled fashion. I think neither Europe nor the Fed can solve the inflation problem in 2 meetings, but I think, my perspective, the US have a somewhat more straightforward trade-off to do.
Christian, I just wanted your thoughts finally on a call I heard from BNP Paribas in the last 24 hours on the ECB. They think that they can go another 100 basis points beyond what a lot of people are thinking about. They think the ECB can go to 3% on the deposit rate. Do you think that's achievable?
I think it is. I mean, what that would do, of course, would put the ECB in actual tightening mode. In an economy which is probably still 3 percentage points smaller than its pre-pandemic trend, and which is heading for a recession, significant recession, that feels like taking it a bit too far. But the more governments are now doing to prevent that recession, shelling out money to households, helping corporates, the more likely it is that the central bank will have to go that way in order to get medium-term inflation down. So I think the risks of, or the chances of something like this are growing, but I still expect a recession. I still expect a recession to stop the ECB before they get to 3%.
Well, they're not forecasting one, are they, just yet? Christian Schultz there of Citi. It's kind of ridiculous, Tom. I think a lot of people are laughing at the ECB's forecast right now. When you've got the Deutsche Bank CEO, and Lisa said this a few times already in the last few months, the Deutsche Bank CEO is going around talking about the depths of a recession, not the if. Not the when, but the depths of it.
I'm going to cut some major slack, John, to any PhD economist who's quote-unquote forecasting right now. I mean, we're moving in real time. You see the headlines here coming out from your United Kingdom, John. My question is, what does Prime Minister Truss do to get to Friday afternoon? I mean, I'm baffled with it. There's some sterling weakness. It's not through resistance, but...
Well, let's talk about this meeting, Tom, so we can go through those headlines. You've mentioned them. The UK government said it will work closely with the budget watchdog. Lisa, this is about optics right now, but I can tell you this is a pretty unusual meeting a week after a budget, a mini-budget, a fiscal event, whatever you want to call it. Typically, you'd come out with those things and you'd get the OBR to come out with some forecasts alongside it, and it wasn't sequenced that way at all.
No, and it even wasn't sequenced for them to have all of the information in hand to come up with this projection at a time when the markets are pretty uneasy about this proposal.
Stupid question. Is OBR the same as the Congressional Budget Office?
I wouldn't know, Tom. I can tell you what it is. It's the Office of Budget Responsibility. It's an independent body that provides forecasts for the government to go alongside their forecasts. Is that the same thing?
Yeah, I think so.
There we go.
I think it's pretty
Then it's the same thing.
Yeah.
We're matching UK and US knowledge together. Beautiful.
It's just amazing.
I know. That's what the show's about.
Watch sterling.
Futures up 0.8%. 368. 3. 368,350 on S&P 500 futures. This is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. Hurricane Ian's winds have picked up speed, and the storm's on a path to hit South Carolina. The forecast calls for Ian to come ashore north of Charleston today with heavy rain and a potentially deadly storm surge. Florida is struggling to recover after Ian made landfall as one of the strongest hurricanes ever in the U.S. Entire communities were wiped out and homes were flooded on both coasts of the state. An exact death toll has not been confirmed. In the UK, Prime Minister Liz Truss is under pressure to cut spending to win back the confidence of investors. Bloomberg Economics projects the cuts may even need to exceed George Osborne's infamous austerity drive of 2010 to stabilize public finances. Markets have tumbled since the Truss government unveiled unfunded tax cuts last week. Well, now there's more pressure on the European Central Bank to keep raising interest rates aggressively. The Eurozone has just recorded its first ever reading of double-digit inflation. Consumer prices rose 10% in September from a year ago, and that's the fifth straight month the inflation figure has exceeded the consensus estimate. Shares of Nike, they're lower today. The sports shoe giant reported that inventory has surged, and it's also had to push through discounts that have hurt profitability. Now, higher freight costs, markdowns, and foreign exchange effects hurt Nike's gross margin in the latest quarter. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Lisa Mateo. This is Bloomberg.
What we're focusing on is delivering the growth plan and making sure, with things like our energy intervention, that people right across this country are protected. And without growth, you're not going to get the public services. We're not going to generate the income and the tax revenue to pay for the public services that we want to see. And that's why the mini budget was absolutely essential.
Kwasi Kwarteng there, the UK Chancellor of the Exchequer, live from New York this morning. Good morning. Equities shaping up as follows, up 0.6% on the S&P. On the Nasdaq 100, up by 0.5%. A little bounce after a pretty rough ride through much of the third quarter. Yields coming back in by 10 basis points, 368.22. I can tell you we were paused for another weekly advance in 10-year yields in America. Tom, let's see if we trim some of that advance through the rest of the session.
John, I would suggest, and this goes to the real yield this afternoon, this Friday is going to be hugely eventful based on some of the dynamics I see right now.
Abramowicz guest hosting. I'm going home early. She doesn't know that either.
I didn't know that either.
Just let her know.
Oh, you didn't know that either, Lisa?
Don't worry.
You're like booking me on air.
Abramowicz, like, I am not hosting that.
Ooh, well, I've got to go look at this guy.
I got to go.
A little Friday.
Busy doing a victory lap into the weekend, Tom. Victory lap, just, the Bears, everyone's on board.
And John, I want to say thank you to everybody listening and watching worldwide who heard John Ferro's questions to the minister here 20 minutes ago. John, the basic idea is Global Wall Street's saying that was a public service. I mean, this goes back to our Rudy Giuliani interview of, I'm going to say, 2 years ago. That was outrageous.
Tom, I think what we need to sort out is there is a difference between policy and approach. You can have a debate about the policy that's come out of the United Kingdom in the last week, and it may or may not turn out the right way. It's the approach to this that I think we need to have a bigger conversation. There is a reason why these institutions are shaped the way they are shaped. There is a reason why there is a sequence of events that is meant to take place. It's to avoid stuff like this. So yes, the UK government wants to come out this morning and try and reshape the optics, that we're all on the same page by constructing that meeting with the OBR, by saying we respect the independence of the Bank of England, all of those things. That wasn't how the conversation went in the lead up to that mini budget. And that's certainly not how things have played out in the last week.
Well, it is sport to say the least. And what we do know is from the moment it was known that Jane Foley of Rabobank would speak with us, pound has weakened from 112 to a 110 handle as well. Jane Foley, I rarely do this, but I've got to get exceptionally narrow here, right down to the GIP function and some of the technicals on sterling. Give us your key support and key resistance levels for cable.
Well, we're seeing huge ranges right now, so that's really difficult to do, but we are targeting 104. Certainly cable remains really very vulnerable because you've got to ask the question, well, what happens when the Bank of England takes away this extraordinary support of the gilt market? You know, the crux of the problem is still there, which is what is this government going to do in terms of its fiscal policies? Now, it's one thing during the pandemic to issue more debt when you had the Bank of England hoovering up some of that debt through quantitative easing, but to try and do that when the central bank has reversed course, it's clearly very difficult to do. Now, the central bank again is going through its quantitative easing program, but that is a credibility issue. Is it supporting the government's fiscal stance?
Jane, explain to us the efficacy of foreign exchange analysis right now. When I look at fancy ratioed financial conditions indexes and fixed income spreads that are grim, does foreign exchange really tell me what's going on?
I think it does. I think sterling has been saying all year that UK fundamentals are grim. Sterling has been a poor performer all year. The Bank of England has been failing to turn sterling around with interest rate hikes, and that's certainly been the case since the spring. And that tells you that investors don't like what they see, and they don't like what they see even more because of the budget last week. And you know, even if some of those measures were to be reversed, and there's no sign at all that the government wants to do that, there is still been a dirty stain now on the credibility perhaps of the Bank of England, but certainly the credibility of this government. And you know, the government's talking about the necessity of this budget because it wanted to improve growth. Well, actually, you know, for many people, a lot of those subsidies on the energy price is going to be taken away in the form of higher mortgage payments anyway. People are going to be poorer as a consequence of this, and also maybe because of the way gilts look in their pension portfolios. So no wonder we've got the latest opinion polls saying that Labour has got a 33-point lead over the Tories at this point.
The United Kingdom has a unique circumstance in some ways, but in others not so much. And we are seeing fiscal spending around the Euro region to try to grapple with what is going to be a difficult winter. How much does this just accelerate the dollar dominance at a time when the U.S. faces a different picture, isn't necessarily engaged in the same kind of fiscal band-aid for a problem that has a longer lasting kind of time frame?
I think it does accelerate the outlook for the dollar. I mean, like you said, the market was already worried about global growth. It was already worried about UK fundamentals, which, of course, is why the timing of this budget was so bad, the Chancellor failing to read those market conditions. But it does accelerate the movement into safe haven for the dollar. But, you know, I would really like to state that I don't think that US fundamentals operate on the dollar in the same way that fundamentals of say, the UK operate on sterling. And this is because the dollar has its own set of fundamentals. It is a huge invoicing currency. It is a massive reserve currency because it's a huge invoicing currency. And the long and the short of it, the simplicity of it, is that when there is crisis, when there is uncertainty, people just need dollars. They need it to cover their liabilities, to pay their invoices, perhaps to cover their dollar debt liabilities, depending on where you are. So the dollar operates to its own set of fundamentals, which are really quite distinct from the fundamentals of the US.
Jane Foley, Jane, just wonderful to catch up with you in London and then back here in New York as well. Jane Foley, thank you, of Rabobank. It's a difficult moment for global markets, and I think there's going to be a massive struggle to normalise. And not just normalise pushing interest rates higher, but also normalise the balance sheets as well. This week for me, for you, Lisa, for you, Tom, I think has been a big week to rethink what is achievable with these balance sheets at the Federal Reserve, at the ECB, at the Bank of England. The ECB, they started this. They told you almost immediately, yes, we're going to hike interest rates, Tom, but we're going to have to do something if yields spike too much on the periphery. Seen this play out in the UK. Unique circumstances, I know. And I just wonder, Tom, how long before the Fed has to reconsider its balance sheet unwind as well?
I 100% agree with you, John. I've been watching this and I see it off real yield, which granted is given back a little bit this week. But John, what I would say for certain on this Friday is every single general counsel of every defined benefit program on the continent and across the United States is reviewing their liability-driven strategy if they have one. And people like Simon Wolfson, Lord Wolfson of Next, is taking a massive victory lap because they had the courage to say, no, we're not going to do that.
It's exposed a real vulnerability this week, that's for sure. Yeah. And the Band-Aid the Bank of England has produced expires in the middle of October. Let's see if it does expire in the middle of October.
Exactly.
And let's see if they move to gilt sales and how quickly. Futures right now up 0.5% on the S&P. Binky Charter, Binky, where have you been? He's going to join us in just a moment from Deutsche Bank. Looking forward to that. Live from New York with futures up 0.5%. Yields lower by 9 or 10 basis points. 368.62. Euro dollar negative 0.6%. 97.59. And crude 81.44. What was it the Russell Crowe said? Bramo, are you not entertained?
You're talking about the markets?
That famous line from Gladiator, are you not entertained? What a third quarter in this market.
Yeah.
Just absolutely. You've never seen Gladiator, Tom?
Never seen Gladiator.
Okay, we've got to fix that. From
Kinda
New
live
York,
it.
this is Bloomberg.
I think it's very hard to make a bullish case right now.
We really don't know what's going to happen, but we also obviously see that there's a lot more vol in the markets.
As long as the dollar and yields continue to move upward, investors need to brace themselves for more pain.
Some of this volatility is really a reaction function to that problem the central banks are having.
It seems like central bankers are willing to push things as much as possible, but not at the risk of financial stability.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
I'm proposing a 4-day trading week. With all the volatility, it should go down to 4 from 5. And then if the volatility calms, Lisa, that you get to, go back to 5. That's how it should work, based on how much people work.
It's going to always be a little volatile. Just
Of course.
So then you can always just take a 4-day work week.
Live from New York City this morning. Good morning, good morning. Bramo looking for a 4-day week. Futures positive, 0.5% on the S&P. I'm on board too. Just doing your work. NASDAQ up by 0.5%. TK on the quarter. Brutal, just brutal. Up and down, up and down, up and down, and heading for another quarterly loss.
The immediate now is so tangible, John, including our conversation with the minister early. I'm hardly focused on end of quarter, and you're absolutely right. It does matter with the VIX 31.29. John, I just looked at sterling, which in the last hour is given way. Full disclosure, it wasn't Jane Foley's fault, John. And I got a resistance of 1.1481. We're nowhere near that. And there's no support, technically.
110.69.
There isn't.
It's a breakdown, and this comes down to how quickly we'll get the forecast from the Office of Budget Responsibility, Tom.
I mean, if I had to go to Binky Chata, I'm like 25 years old and I'm shaking going in front of Chata. I'm like, the charts tell me I don't know where I am.
Binky's going to join us
right now.
very, very shortly. And Lisa, with Binky, we need to talk about some of these big tech names. Yesterday, B of A downgraded Apple. Apple got really hammered, slapped around, just on this idea that consumer spending is going to be a tough story worldwide. Facebook, Mark Zuckerberg, out with freezes to hiring, not layoffs, but a hiring freeze. And I guess you can't freeze what you can't sack what you can't hire.
And he basically is saying that Meta or Facebook is going to be a smaller company in 2023 than it is today. All of these cuts, et cetera, come as you get the semiconductor space flat on its back, coming out. Micron yesterday coming out, downgrading its expectation even further than people had expected. Taking a step back, at what point do the biggest names see this kind of loss? And then that triggers something. That triggers some financial risk, some financial stability issue that we saw, yes, in the United Kingdom. But as Larry Summers said, these are the preconditions for just that type of event here.
It's been very messy this week, that's for sure. It could be a stronger finish. Let's go through it. Futures positive, 0.5% on the S&P. On the Nasdaq 100, up 0.4%. Yields lower by 9 basis points on a 10-year, 3.69. Euro dollar 97.65. We're negative 0.5% on euro dollar at the moment. Tom talked about sterling weaker. Dollar stronger through all of G10, basically, Lisa, with the exception maybe of the Japanese yen.
Yeah, and it was because possibly the intervention that we've been hearing about in terms of how they are trying to support that currency. Jane Foley on just moments ago saying that she doesn't really see what could stop the dollar rally. A lot of people are in agreement. Today, we did get some sense of how long that meeting was with Prime Minister Liz Truss, Chancellor Kwasi Kwarteng, and the head of the Office for Budget Responsibility. We're hearing reports that, as Tom said, it was 48 minutes long. We now are waiting to hear what emerged from that. Are they bringing forward the timeline? This matters. It matters for what we're looking at in the pound. It matters for how much the Bank of England is going to have to raise rates. And it matters for people who are having to refinance their mortgages at rates or even just deal with raising rates at a time when, according to one report, they're hearing reports of 10.5% mortgage rates being cited. Today, we get August U.S. personal spending, income data, core PCE deflator, all at 8:30 a.m., followed by the University of Michigan Sentiment Survey at 10 a.m. I remember for a fleeting second that Fridays were University of Michigan Sentiment Fridays. highs that lasted all of a week. And now we are looking at the core PCE deflator. When we take a look at how quickly some of that base effect is really taking effect and how much the Fed can look at this for a bit of reprieve. This is their favorite metric. Do we see some sort of roll-off in how high inflation is? And at 11:30 a.m., President Biden is delivering remarks on Hurricane Ian and the potential recovery there. John, I was reading one estimate that said that the recovery costs in Florida will be an estimated $69 to $100 billion. It will change the coastline forever. This is the third most populous state in the United States. It is an area that has seen a huge amount of people migrating there during the pandemic, post-pandemic. It is actually a disaster zone in many areas right now.
It's deeply upsetting for a lot of people. And Lisa, thank you so much for staying on top of the story. We'll continue to bring you updates for the next couple of hours, all day in fact, on Bloomberg TV and on Bloomberg Radio. Turning back to the markets, Binky Chadha joins us, Chief Global Strategist, Head of Asset Allocation at Deutsche Bank. Binky, you still at 47.50 year-end on the S&P?
I'm not still at 47.50, but yes, that is what I'm looking for at year-end, yeah.
47.50, how do we get there, Binky, in 3 months?
I mean, the basic thesis is, I would completely agree, given where we are basically in the cycle. There's really no case for equities based on either earnings or the valuation of those earnings. But I think, what one should keep in mind is what we've seen basically over the course of the year is the Fed, providing guidance basically to a full rate hiking cycle, which is basically, in my view, given that 4 out of 5 of them ended in recessions, it's really, forward guidance to a recession. So what we have is a situation where basically growth has been slowing, but with the Fed's guidance, equity positioning has been falling much faster basically than growth has been slowing. I would say if you look and break up our positioning measures into sort of 2 parts, one that's basically tied and based on what's happening from an economic fundamental point of view and earnings, what you see is discretionary equity investors are positioned right now for 46, 47 in the ISM, manufacturing. What we've got the last 3 months is basically 53. So, there's potential for a squeeze, but I would argue, the much bigger potential for a pretty big squeeze really would come from the systematic strategies. I would say if you look at
they're going to step in and up we go.
It's a question of basically, systematic strategies positioning at the end of the day is best explained by equity vol, and equity vol is just very elevated.
I got two ways to go here, Binky, off of John's question, and I've got to go to the one that matters. Luzetti came out at Deutsche Bank and said recession before anyone else. I know you respect Folkers, Landau, and Luzetti. They're getting it done. They've been phenomenal. But are you suggesting at the heart of your bullish call is this Fed blinks?
No, I wouldn't say that. I would just say, yes, we are looking for a recession, sometime next year. The question is, exactly when, and is it going to happen here and now, given where, equity market positioning is? What, I'm calling for is, bear market rally number 5, and it's likely to be bigger than number 4 is all I'm saying. Bear markets have plenty of rallies, on average 3 off of new lows, going 10% or more. The 2 recessions prior to the pandemic, we saw, on average, basically 5 bear market rallies of 15%. I would argue at this stage in the cycle, you just have to be tactical, because we have this cloud of basically recession.
So, Binky, I remember a couple months back, you put out a forecast where you said if we get a recession and a hard landing, you could see, I forgot whether it was a 3,000 or 3,200 handle on the S&P, or on the high end, closer to this 47.50 or even to the 5,000s. It seems like the worst case scenario is kind of unfolding according to a lot of people, and many more people are pricing in a hard landing. What makes you stick with the higher end range?
So it's not really the higher end range. It's sort of an if then else and what happens when, basically. I would argue, coming through basically the middle of the summer, it seemed to us actually that recession was probably more imminent than happening next year. I mean, if you look at, so it also depends on what you sort of think or believe a recession is. I think a recession is really basically about corporate risk aversion. And if you looked at, simple measures of CEO confidence, you would see that in the middle of the summer, we were basically, some of them were actually below the lows at the time of the pandemic, which is, all the way down there. And so, really primed for corporate risk aversion. When we got basically the commentary on Q2 earnings, though, I would say, corporates are pretty clear that, they're not cutting anything preemptively. So that argues and simply suggests that, the recession's likely happen later rather than now. And that leaves us with the issue of basically what's going to happen over the next, sort of 3 to 4 months. And what I would also point out is that if you look at those measures of CEO confidence, there are a couple, there's at least one that's available on a monthly basis. And what you see is that CEO confidence actually went up in August and then went up again in September. It's actually doing exactly what consumer confidence has been doing. So, yes, I mean, the Fed hiking cycle will end in recession. I think the question is timing, or, working thesis, house view is, around the middle of next year. So that still leaves plenty of time in between, is the way I would put it. Yes, but if we go to a recession, yes, 3,000.
If we go to 3,000, I'm right. If we go to 4,750, I'm right. Binky, that's just the way
it's a question of when. It's a question of when, John.
Well, Binky, I just want to give you the chance then, because it's not for me to say your forecast is going to be wrong. You're saying that we can rally back basically towards all-time highs before year end.
That is correct.
Okay.
If you look at basically, big corrections in the S&P 500, and generally, I mean, the kind of levels that we are talking about right now, where we are, you only see basically in recessions. But in the few cases when we fell by as much, and we did not actually go into a recession, the market actually regained its prior peaks in about 4 months. So that's something to keep in mind. So the question is, is the recession happening, and is it becoming more imminent, or is it getting pushed out? So whether you look at CEO confidence, whether you listen to, company commentary, whether you look at the labor market data we just got yesterday, all of that saying it's postponed a little bit.
At the end of a football game, American football, when there's like 20 seconds to go and they're sort of deep in the field and they throw, what's it called, Bram? A Hail Mary?
Yeah, Hail Mary.
This feels like a Hail Mary into year end. Binky, if it lands, credit to you, and we'll talk
John,
about it.
Do you know who Doug Flutie is? Have you ever heard the name Doug Flutie?
Who's that, Tom?
That's a guy you need to study.
Okay.
He's the king of the Hail Mary.
King of the Hail Mary. I'll check it out. Binky Cheddar at Deutsche Bank. Thank you, sir. Futures up 1/3%. Hey, you wanted a bull.
There we are.
We got it. Delivered.
There we go.
Signed and sealed.
This is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. Hurricane Ian is taking aim at South Carolina. The storm's winds picked up to 85 miles an hour overnight, and it's expected to make landfall today north of the historic city of Charleston. Ian caused catastrophic damage in Florida, where it came ashore as one of the strongest hurricanes ever to hit the U.S. The storm flooded towns on both coasts and wiped out entire neighborhoods. An unknown number of people are still believed to be trapped in their homes. British Prime Minister Liz Truss won't change course on the government's unfunded tax cuts. That's following talks with the government's budget watchdog following a week of market turmoil. Bloomberg's learned Chancellor Kwasi Kwarteng will stick to his plan of delivering a medium-term fiscal statement on November 23rd. In Brussels, European Union energy ministers have backed a package of measures to fix the natural gas crisis. They include a goal to reduce power consumption and agreeing to tap windfall profits of energy companies. Still, there's some frustration that more hasn't been done. Vladimir Putin is set today to annex parts of Ukraine that Russian troops control, and that's after a referendum condemned by the United Nations and called a sham by President Biden. Russia plans to sign treaties to absorb the 4 Ukrainian regions. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Lisa Mateo. This is Bloomberg.
We're bearish European natural gas going into January and February and see it trading below 100 euros per megawatt hour. We believe, barring an absolutely freezing cold winter, they're going to get through this winter, prices are going to moderate, but longer term, you have a problem.
Jeff Curry, constructive short term, very much not constructive long term there. Global Head of Commodities Research at Goldman Sachs. I'm told that if I've never heard of Doug Flutie, that's like not knowing who Paul Gascoigne is. But since you guys don't know who Gaza is, I'm not going to go there.
That's absolutely correct.
Futures up 1/3% on the S&P. On the Nasdaq 100 up 1/4%. Elsewhere, yields are lower by 9 basis points on a 10-year, 369.81. Euro dollar 97.57, down 0.6%. If you missed it, a couple of hours ago, we had inflation out of Europe, double digits, 10%. Next ECB meeting, October 27, and they've got CPI year-end at 8.1%, next year at 5.5%, the year after that 2.3%. Double-digit inflation, Tom, in Germany, double-digit inflation in the Eurozone.
On a slow Friday, folks, I really want to emphasize, as John just mentioned, there is no bet on euro in the last hour, and also on sterling. Is it inflammatory? No, but it's tangible. They have given way off of the news flow of the last hour that you've seen, including our interview with the Prime Minister Truss's Treasury Minister of some form, the city minister as well. Right now, we speak to Minister today on Brussels and Minister Horton in Washington about the events of the weekend. Maria, I'm going to go to you. And that it's the only question I've received this weekend as people stop me on the street. Who's going after Vladimir Putin? How alone this weekend is Vladimir Putin?
But actually, Tom, I thought I'd be a prime minister more than minister. But, in terms of who's going after Vladimir Putin, it's a very difficult question to answer. And in all seriousness, it is a difficult question to answer because the Europeans, what they say is, we are not fighting this war. We're not belligerent in this. We are supporting Ukraine because this is a country that is being attacked on the battlefield. But I can tell you, though, that the Europeans know that in about an hour's time, Vladimir Putin will announce that he will annex 4 regions in Ukraine, and that will pave the way for more sanctions on Russia. Now, it is unclear what type of sanctions, because the Europeans have pretty much done everything that they could. The one issue they can't is gas and energy, and there is huge frustration here about the fact that bills and prices are not going down fast enough.
Has this dialogue, Maria, changed with the Italian election? The reality of the politics of Hungary and other Eastern European nations. Are we having a different conversation now on sanctions and on Vladimir Putin than we had on February 25th?
There is a different conversation, but so far it's not in sanctions. It's about this mega plan that Germany presented yesterday. Remember, it's 200 billion euros in new debt to be able to finance and cushion the impact of this crisis for households and families. And what I can tell you, Tom, is that behind the scenes today in Brussels, there's frustration at the Germans. The idea that they are disrupting in some ways the markets, that they are breaking away from that solidarity and that unity in Europe because they have the money to do things that other countries are not able to. So in fact, the conversation is not so much about the sanctions, whether it changes or not, but it's more about whether Germany is going at it alone or will stick with the rest of European countries.
And Marie, the way that Europe is configured right now, they are proposing to borrow money to try to plug the gap in the energy system right now for households, for companies, and beyond. How much, when we look at the U.S. and some of the spending that needs to happen on infrastructure and some of the spending that needs to happen to recover the situation down in Florida right now, the disaster where you do need to rebuild, how much does the U.S. have that capacity to do that, given some of the projections?
Well, they really don't have a choice, right? This is a natural disaster. This is a defying moment for not just the governor, Ron DeSantis, but also, of course, of President Biden. There was a great analysis this morning in the Washington Post that really showed, and to Tom's point yesterday, how this can shape a presidency. And it is really crucial to make sure that the federal government is seen as really being as a helping hand to opening the taps on whatever is needed, especially when you're looking ahead to a midterm election. If I could just say one point to Maria's about Germany and that they're in this incredibly more secure fiscal situation. I was kind of struck by the German economy minister's comments this morning, Robert Habeck, taking a little bit of a direct call to the places like Norway, like the United States, which are now starting to fill that gap where Germany used to get very cheap Russian gas. Sometimes others would maybe say at the expense of other European countries. Now basically telling those countries that Europe should be in a negotiating power and making sure those countries are not exploiting these sky-high prices.
Okay.
And what we should note about what's going on in the U.S. right now is they are making a lot of money in terms of sending over fossil fuels to Europe.
So, Anne-Marie, to that point, I mean, what's the pushback from the United States? Is there some sort of response? If there is going to be increasing pressure to lower the prices, is there a willingness to do that for an alliance and trying to keep Europe in a better situation during the winter?
Well, this is Mr. Havak's response. We need to be an alliance. Should be a partnership. And the United States is, I'm sure, going at all of these moments. And they've said they want to help Europe. They are shipping tons, the most ever on record, of LNG to Europe. But these are private companies, and these are supply and demand issues. And I'm not sure I see the United States going to be able to put pressure on LNG companies to lower their prices to fill the gap in Europe, especially when Europe is in this very vulnerable time and they almost just don't have a choice.
AMH, thank you. Anne-Marie down in DC alongside Maria Tadeo over in Brussels. TK, you are never going to win Maria over. You know that, don't you?
Yeah,
it's just not happening.
It's like
you're going to keep trying, though.
Just
it's not working out. Thanks to Joe Weisenthal of the Odd Lots team for writing this one up. Bloomberg's chief economist of financial products, Michael McDonough, put this together. Tom, if you wanted to spend $2,500 a month on a house, that would cost $476,000. For that same monthly payment, you could have purchased a $758,000 house in early 2021. That's just how much interest rates have changed. So a $2,500 payment a year ago, Tom, your house is $760.
Right.
Now that house is going to cost you $476.
37%.
Your budget has shifted massively.
Well, and culturally as well, 37% decline in value. Thank you, Liz Ann Saunders and David Gura, for selling that out on Twitter for Mr. McDonough. John, you see it as well, and I really don't understand this market. The Telegraph moments ago with an HSBC analysis of the mortgage payment from, I believe, fixed to floating, John, correct me on this, moving from an annual £3,500 increase to £5,000 increase.
So those fixed mortgages, Tom, once they're done with, you're going to get a big step up in interest payments. I think there's a big wall of that set to take place in about 12 months. Then about 20% of the mortgage market in the UK is floating rate, variable rate mortgages, Tom. So that will adjust off the BOE's next big move, and it's going to be a big one.
Yeah, I'll have to see.
Futures positive a third of 1% on the S&P from New York. This is Bloomberg. Live from New York, looking for a bounce here, up a 0.5%, just about, up 0.4% on the S&P. On the Nasdaq, up 0.4% also. On the Russell, small caps up 0.6%. On the quarter on the Nasdaq, third straight quarterly decline we're poised for here. Worst since the third quarter of 2002, that losing streak. That's unreal. I had no idea about this. And a quarterly decline was set for on the S&P as well. Another quarter of it, longest quarterly losing streak going back to 2009. We haven't seen this for a long, long time. That's the equity market story. Here's the bond market all over the place. Your 10-year now, 369.21, yields lower 9 basis points. We've gone from through 4% early this week and down to 369, quite a range. You want a bigger range than that? Look at pound sterling, 103.50 Monday morning, 103.50. Then all the way back through 111, looking at 112, and now back to 110.71. You're up to speed with this one, Tom. Cable, what a range.
Well, the range is there, and there is some resistance. I mean, you can make a chart, and up it goes, and there's something it has to break through. But what's important here on a weekly chart, John, there's no support. Technically, it's what I call soup, in that it's hugely indeterminate. And that tells me, John, it's based off every single Bloomberg headline and red sticky that we're going to see from the trust government. That's really... you may get some liability-driven scandal and derivatives, but to me, it's mostly the trust government news flow.
Yeah, and getting the sequencing in order. And Lisa, also, there were some thoughts this morning that maybe they'd accelerate that planned economic forecast from the OBR, and that doesn't seem to have happened in that meeting this morning.
Well, not only did that not happen, but our reporting is that they didn't even request it. So, John, you do have to wonder, are they even thinking like that? Or are they just hoping, the storm will pass, and if we just job on enough, the markets will cooperate?
We'll see. We'll see.
Meanwhile, one thing that I'm looking at, and that's on the sort of macro picture that you were talking about, is just some of these specific names as they report earnings. And Nike really caught my eye. The good news, I guess, is that you can get things on sale there. That seems to be the takeaway headline here, because their inventory surged by 65%, well beyond what people had expected. Margins came in much more, really difficult for them. Basically, they have all of this stuff that they can't sell as quickly as they thought that they were. It's building up, and so they have to discount it aggressively to get it out. They're not alone. Those shares down nearly 10% in pre-market trading year to date. It's been a bloodbath in the retail sector. I mean, it's been incredibly difficult at a moment where they really haven't kept pace with some of the shifting trends in shopping, as well as just people buying less stuff. Nike shares down, just not even including today's move intraday, if it sticks, 43%. Adidas down almost 60% as they deal with some of the same issues, and Under Armour down 64%. So actually, with all of this, Nike's actually doing the best, but it is an incredibly difficult moment. And this is one reason why investors come on and they're looking for an entry point for some of these. They say that early next year, and this goes to the point that Michael Hartnett over at Bank of America was talking about, at a certain point, have we just completely stripped valuations to such a low level for some of these names that got first, that were hit hardest and first, that they start to become attractive, perhaps, when we start to understand the scope of the downturn.
Lisa, thanks so much. Right now, on what you're going to do to restructure for Q4, restructure your life as we're all poor in the equity market, Marvin Lowe joins us, Senior Global Macro Strategist at State Street. Marvin, when you take the global strategy and you fold it into the investment strategy, what is your to-do list the first business day of October?
I mean, I think you're still trying to assess how comfortable you feel with the path that's been laid out on the monetary policy front. If you're getting comfortable with that, you could certainly talk about some of the bottom fishing that Lisa talked about. We, on the other hand, still think that there's a great deal of uncertainty. So you stay defensive. You still continue to look at the shape of the curve that put you in a defensive position, and this dollar strength that seems to be making its way around the world is something that will likely continue in our view.
We have seen central banks in some forms blink in the last number of days. In all my reading, Marvin, including this weekend, whenever I see the word hope, I circle it because that usually means danger. What is our hope for the Central Bank of the United States? What are we hoping Jerome Powell does?
I mean, I think we're hoping that they stick with the script that they put out, as painful as it's going to be. We see kind of how inconsistent some of the central banks' messages are needing to be, particularly around the UK, where on the one hand they say they need to tighten, but on the other hand they've started QE again. Certainly potentially a one-off, that's the hope, but it really does show how challenging an environment it is. You can't deal with the systemic risk that's building in the market the way you used to because of this inflation. So I think that we really need for the Fed to stay with their message and make inflation the main enemy that they're going to fight.
Marvin, we just had Binky Chadha on a bit ago here on the show from Deutsche Bank, and he was saying he still thinks that you could see a 4,700 level on the S&P by year end because of a bear market rally. Are things that volatile that you could see that kind of move, that you could actually see rallies of a significant magnitude that would give you as a defensive investor an opportunity to sell?
I mean, 47 feels pretty aggressive to me. It would be a repeat of the summer for the most part. And I don't think we're going to have an environment that allows the summer to repeat. If anything, the Fed is in a mode to make sure that doesn't happen again. Can we have a bear market rally? Sure. Absolutely. 8 to 10% in this kind of environment is not unheard of. And it does provide you an opportunity if you're short-term in nature. I still think U.S. stocks for the long term is part of your portfolio. But, between here and there, there's going to be a lot of volatility around it. And, I'd add that the VIX certainly has crept up, but it's not at concerning levels. So you really haven't had that feel of capitulation, even though you've had as much volatility as you've seen on the price front.
Marvin, you said that we haven't seen that capitulation yet, and that certainly has been what a lot of people are saying. But around the margins, it feels like something is happening that is different now than a couple of weeks ago. Over the past week, we saw the biggest withdrawal from U.S. investment-grade bond funds on record. We have seen losses in that debt unrivaled in memory in recent history, and even not so recent history, of nearly 18% so far year to date. Are things starting to crack in credit?
Yeah, they absolutely are. Kind of having said that, Lisa, and you certainly know the high yield market as well as anybody else, we're still a ways from retesting the wides from a spread perspective that we saw earlier this year, and those wides didn't reflect recession the way that we would typically define it. So it is starting to crack. There's reality coming into those markets at a time when they were able to, ultimately talk through them. Kind of having said that, if that reality does set in, there's still more losses that are going to come into that market.
Marvin, off script, but I think on the mind of everyone in global Wall Street is we all calculated the leverage of 1998 that we observed. I'm going to use 16 to 1, even 20 to 1. And I guess there's a comfort that the ratios that we're talking about in the last couple of days is a 3 to 1 imputed leverage as well. Is the leverage out there within the financial system to give Andrew Lowe upset at the Massachusetts Institute of Technology that would upset Marvin Lowe at State Street?
I mean, I think we definitely have had a better handle on leverage this time around, relative to a few of the other financial crises. So I'm not necessarily looking at it from that perspective. Having said that, what we learned from the UK pension funds is that it could lurk in sometimes the most obvious places. It doesn't make sense in hindsight, but these are strategies that potentially evolved over a decade in an environment that was very much geared towards lower interest rates and in a more stable environment. I wouldn't say it's there, but there's nothing obvious to me relative to what we learned, really over the last few decades and unfortunately a few of the last financial crises that we've gone through.
Marvin Lowe, thanks for being with us, sir, of State Street. Still 3 months to go of this year. Yeah. I keep saying that. It's been such a long year already. What a story through the third quarter, never mind the whole of 22 so far. Futures, Tom, up 0.2%. Sterling now weaker on the day. Cable, big turnaround in the last couple of hours. I've got to say, this market, Tom, has just been all over the place all week.
I looked away for 12 seconds and sterling weaker again. Careful to watch. I'm not in a panic about it, but hey, there it is. John David Blanchflower, very busy and all out on Twitter, thinking of him and the millions in Florida affected. The professor from Dartmouth College with a set of blistering tweets. John, this sounds like Ferro about 6:02 a.m. However, they said the forecast, which we'll receive on 7 October, won't be published until 23 November. The government also said it values the OBR scrutiny. What a load of rubbish. Not going to happen. We won't let them hide this stuff. Appalling. John, that sums up the street.
So that's the second piece. I'll ignore the second piece, Tom, because that's heavy on opinion. Let's talk about the first piece of this. November 23rd. I wonder, Tom, whether this new budget now, and it's certainly not a view unique to me, that if it includes spending cuts in a big way to offset some of this, TK, I just wonder how much more painful this could become in the next 6 weeks, next 2 months for that matter.
I urge everybody, I'll put it out on Twitter, John. Everybody's got to go read William Greider on David Stockman, written in 1981. I'll read it this weekend, as I did 40 years ago. I can't believe I'm saying that. John, this has so been there, done that before.
Sure.
It's shocking.
Tom, this started...
That's why I got upset with the minister.
This, Tom, started, I think, when you had Boris Johnson on his way out. And on his way out, he talked about the Treasury. And he talked about the Treasury and how they like to balance the books, and they're too focused on that and maybe not on growth. And then the first thing they did when they took over is they basically fired a top civil servant at the Treasury. This is how the dominoes started to fall. The Chancellor came on board. He said they were ran more like a finance ministry. They want to focus on growth, and it's gone from there. Tom, if you're going to blow up orthodoxy, that's one thing from a policy front. But if you're going to do it on your approach as well, that's going to unnerve a lot of people.
Yeah, well said, John. I haven't asked this question because I don't want to be rude, but I'll be rude to you. Would this have happened under Prime Minister Johnson?
Tough to say, Tom. Tough to say. I think under Prime Minister Boris Johnson, you maybe have got your own idea about what policy should have been. So Tom Scholar was still at the Treasury at that point.
The gentleman.
That gentleman, that top civil servant at the Treasury, he didn't blow up the approach in quite the same way as this government has done in the last couple of weeks, Tom. And it's the approach, again, I really draw a distinction between the policy, and we can have a debate about whether this is the right policy, but the approach, to blow up the approach, to say that we're going to do this without the OBR forecast alongside us, that kind of stuff is just, it's messy, and it's been messy, and you've seen how it's played out in the market too. Futures right now, positive 1/3% on the S&P. From New York, this is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. Hurricane Ian's winds have picked up speed, and the storm's on a path to hit South Carolina. The forecast calls for Ian to come ashore north of Charleston today with heavy rain and a potentially deadly storm surge. Florida is struggling to recover after Ian made landfall as one of the strongest hurricanes ever in the U.S. Entire communities were wiped out and homes were flooded on both coasts of the state. An exact death toll has not been confirmed. There's more pressure on the European Central Bank to keep raising interest rates aggressively. The Eurozone has just recorded its first ever reading of double-digit inflation. Consumer prices rose 10% in September from a year ago. That's a fifth straight month. The inflation figure has exceeded the consensus estimate. Over in China, Bloomberg's learned that regulators have told the biggest state-run banks to provide $85 billion in financing to the embattled property sector. That's for the last months of 2022. A property slump has been weighing on China's economy for more than a year. In Brazil, President Jair Bolsonaro and former President Luiz Inácio Lula da Silva traded insults in their latest debate before Sunday's election. Bolsonaro called Lula a liar and an ex-convict. Lula accused Bolsonaro's government of corruption. He leads in the polls by a wide margin. Lula could win in the first round if he gets more than 50% of the votes. And shares of Nike, they are lower today. The sports shoe giant reported that inventory has surged, and it's had to push through discounts that have hurt profitability. Higher freight costs and markdowns and foreign exchange effects hurt Nike's gross margin in the latest quarter. Global news 24 hours a day on air and on Bloomberg Quick Take. I'm Lisa Mateo. This is Bloomberg.
If you see U.S. real rates rise to the extent they have and with the speed they have and the negative reaction to equities, at some point, it's hard to know when, but at some point, even the Fed blinks.
Based on the Fed speaker the last 24 hours, not yet. Dean Kernet, founder and CEO of Macro Risk Advisors, live from New York City this morning. Good morning. Equities bouncing back and then they fade. Up just 1/10% on the S&P, on the NASDAQ, up not even 1/10%. Yields were lower, they're still lower on a 10-year by almost 10 basis points to 368.82. Euro weaker by 6 or 7/10%. Euro dollar 97.52. CPI out of the Eurozone today. Inflation, Tom, coming in hot, double-digit CPI. One ECB official from the executive board speaking right now saying there's a risk of expectations de-anchoring on inflation, Tom, and that means the ECB, in the minds of the ECB officials, has a lot more work to do.
How does that theory work with the Netherlands at inflation of 17.1%? And I know there's a set of yeah buts, John, but does theory work here, sort of like a 7 standard deviation move on the theory of a derivative strategy in a pension market?
How do you re-anchor inflation expectations, Tom, when you have massive financial stability concerns alongside that? We've seen that in the UK this week, and I would argue Italy, I'm not saying it's a red light, I'm saying it's amber, starting to turn, Tom, starting to turn.
For John, Lisa, and I, and all of our team, we are going to continue to monitor this through the weekend as well, and it is across equities, bonds, currencies, and hydrocarbons given a war in Ukraine. Expert on this is Regina Mayer, global head of energy at KPMG, which barely describes a nexus of her military experience with the study of hydrocarbons at Rice University. Regina, thank you so much for joining today. What are you watching in the oil and gas market? When you begin your day, what is the thing we need to focus on right now?
So when I'm thinking about what's happening in Europe, because that's where there's a lot of attention these days, I am looking at 3 things every day, Tom. That is, what is the natural gas stock supply look like? What are the spot and forward natural gas prices in Europe? And what do we think the weather projections will be, both for today, tomorrow, and the coming winter? I'm near-term optimistic because European gas stocks are at 90% of normal for this time. They were at 50% over the summer. So I think the EU's done a great job of rebuilding that stock. Short-term prices are down 50% from their highs over the summer, though they're still 200% higher than they were this time last year, but they've halved by the summer. And I think we're hoping that the weather stays more in our favor. So near-term optimism, but those are some of the things I look at.
Near term. What about longer term?
Yeah. Well, longer term, there's so much volatility. If you just look at this week alone, Lisa, crude oil price jumped around 8 to 10% up and down. And so I think the market has a lot of jitters. We saw some downward price pressure with recessionary concerns and the strengthening of the dollar. But then we worried about demand because the market got jittery with what's happened with the Nord Stream pipelines, even though that actually does not affect near-term European gas supply because those pipelines were not serving Europe. But the EU has done a great job of reducing its short-term dependence on Russian gas. And so I think that the added threats will create upward price pressure. It will continue that, but the recessionary fears, the rampant inflation that y'all have been talking about, that creates a downward price pressure that keeps us more in balance. Some analysts are pegging average crude price for 2022 to be in the 70s, which I don't think I would have expected that just 3 months ago.
Well, sticking on the energy story in Europe, we heard from Anne-Marie Herdern, our correspondent in Washington, D.C., about how there are increasing calls from Europe for the U.S. to lower its natural gas prices as it exports to Europe, to give them some assistance through the winter. Do you see that as a realistic outcome, that the U.S. is willing to provide marginal demand and somehow cap prices in some manner?
I did think that was interesting in the paper that the EU has issued about creating an LNG transaction-based benchmark. The markets are very transparent, and hydrocarbons have been trading in the ways that they've been trading for almost decades, right? So I don't know how successful that will ultimately be, given all this volatility that we've been talking about. I do think, though, the governments are really interested in having more unified policies to protect their electorate and to secure energy supplies for the coming winter months.
Regina, the Netherlands was 17% inflation. In the hydrocarbon part of that, I believe, is 114%. Just unimaginable numbers. What are the ramifications if we get 90 days of 17% inflation in the Netherlands?
Well, I'm not an economist, Tom, but I think you're seeing major price escalation. I'm talking to a lot of senior executives that run manufacturing companies all across Europe, and their energy costs are through the roof. And that cost then has to get translated back down into goods and services that go to consumers. And that, I think, is what's driving some of these crazy inflationary numbers that we're seeing. And until we can drive that overall energy cost down, they're making short-term decisions to cut manufacturing runs as a demand management response. But I think we'll continue to see a lot of upward pressure on price given these higher energy costs.
Regina, thank you. And thanks for making it this morning to join us. We appreciate it. Regina Mayer there of KPMG. Tom, what this feeds is just this idea that maybe the peak for inflation in Europe is still in our future. Still in our future at a time we've been spending the whole summer talking about peak inflation being behind us in America.
And that's the uncertainty, and it's a litmus paper on a Friday morning, of global Wall Street. And John, you see it with Euro just giving way to morning weakness, sterling on the cusp of morning weakness. And very importantly, John, DXY vaults up where we begin to think about a revisit to 113. A plus 114 DXY, John, would be grim.
German yields coming in today. A little bit. In Italy, we're down 12 basis points. But Lisa, that's not been a story more recently over the last month or the last 12 months for that matter, as it has not been a story at all. To see double-digit CPI, I don't think we should let that slide. We've seen double-digit CPI in Germany this week, in the Eurozone more broadly.
10.9% in Germany, 10% across the Euro region at a time when they feel like they have to, I'm talking about policymakers, support households and give them some fiscal assistance heading into a winter. This is a deeply uncomfortable moment, and the shift that we have seen in yields. Someone asked me yesterday, why is the bond market more important than the stock market? And I went back to what you said, John, yesterday, which is when you have a problem, when you have the biggest risk in risk-free assets, that's when crises happen.
I thought the rant would have been a lot longer than that.
Well, it was. That was the beginning.
Did you deliver just a massive speech about why fixed income is more important, people in fixed income are so much smarter? I don't think you finished there.
No,
I don't think you finished there at all. Do you know the song that the bonds don't work, they just make things worse? You ever heard that song? Okay, it's my song, they're my lyrics.
Was that ABBA?
That was ABBA, Tom.
I thought so.
That was ABBA.
I got that right.
I think the actual song was the drugs don't work, they just make it. Anyway, the bonds don't work, they just make
British humor,
things
Lisa, go
worse.
with it.
And it's bond market humor. Just let me run with it. That's been the problem in this market. And at the moment, we're all talking about recession. bond market's not getting a bid in Treasury. Sure, it's come down from 4 to 369, but given the recession we're talking about in America, high interest rates and all of the above, wouldn't you expect us to have maybe a 2-handle, a 1, and that's the world we're in?
Because of the sea change where you have central banks selling their assets, it's a difficult moment.
Totally, and with inflation where it is too. Jim Paulson's coming up of Luthold. Looking forward to that. This is Bloomberg.
If this financial dysfunction gets bad enough, the Fed is going to have to blink.
The blinking is probably going to start in 2023 when the U.S. Fed cycle, essentially comes to an end.
Regardless of the dysfunction, they will continue to raise rates.
The tightening is going to have to be persistent, at least for the next 12 months.
We're optimistic that by the end of next year, the Fed's going to be much closer to where it wants to be without necessarily having to pull the economy into a recession.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
Good morning, everyone. Jonathan Ferro, Lisa Abramowicz, and Tom Keene on an extraordinary Friday. I'm going to go with Contagion Friday is what we're looking at. And, John, the contagion starts at 10 Downing Street and over at the Bank of England.
I'm very aware that my audience is far, far smarter than I am. So here's the update to the Verve lyrics. Because the swaps don't work, they just make things worse. But I know that we'll get bailed out again. Story of the market this week, Tom. Huge moves, and the Bank of England stepping in with a big gilt market operation. That's a band-aid, though, TK. We've talked about that a million times. It has an expiry. It's the middle of October. Let's see if that's when it expires.
There's so much insight here, folks, and so much reading for the weekend in this historic time. I don't want to derail the opening, John, right now. John, let's just go to what's happened in the last hour in London that affects global Wall Street.
They met with the Office of Budget Responsibility. There was a hope that maybe we'd get some independent forecasts to go along with this budget. The Prime Minister and the Chancellor walked away from that meeting. It doesn't look like we'll get those forecasts, Tom, until we get an update to the budget again in late November. So the timeline as follows, and I've gone through the dates a few times. I'll do it again. The 14th is when the operation of the Bank of England ends, set to end. November 3rd is when we get an MPC decision on monetary policy from the Bank of England. Then the end of November is when you get that fuller fiscal statement from this government, Tom, and that's quite a runway. 2 months is a long time in this market.
We're voting now in the foreign exchange market, weaker sterling, and we'll get to that in the data check. But, Lisa, we vote in the bond market, bills, notes, and bonds. Lisa, what have you observed in the last 24 hours?
Credit is softening. There is a different tone in the credit markets, and this is notable because for a while we had not seen that. You saw the biggest weekly outflow from top-rated corporate bonds in the United States ever on record, the third biggest, and you have an ongoing deterioration in the valuations at a time when companies are withdrawing bond sales. They do not want to be exposed to this market right now, and we're headed toward possibly one of the slowest months of bond sales for a decade, at least that is the Bank of America expectation. This matters. People have been saying, when's the bond market going to crack? When is credit going to crack? There are cracks. They're kind of forming, Tom.
On radio, a chart now with the derivative strategist, Jonathan Ferro. John, let's go there. This is a chart I did a couple days ago. I haven't seen it anywhere else in the world. This is a certitude of the second rate in the derivatives market, which Lawrence Summers in the last hours has mentioned. Only once, John, in 20 years did we go out to 2 standard deviations. John, this was a guaranteed sure thing in Mayfair.
And then it wasn't.
The green circle, folks, way up top is trend, comfortable. Let's have lunch at that Indian place, John, you like in Mayfair. And then down we go 4 standard deviations. That's where we get a little sweaty. And we are at 7 standard deviations, and the certitude drifts away.
Can I just say, Tom, Jamavar, my favorite Indian restaurant in Mayfair. Just throwing that out there just so everyone knows. And
that's very good.
Go and visit. It's a
John,
bit pricey. I understand.
I'm going to go with Lawrence Summers here, and it's not original to the great professor. Every time you see a derivatives blow up, there's little redounding moments out there. They're out there this Friday.
What this speaks to, Tom, and these pension funds in the UK were invested in these specialised investment funds. They had margin calls on trades. A lot of people had to basically sell some positions, but the most liquid positions they had were gilts. They sold gilts to raise cash to meet those margin calls, and of course selling gilts just made the whole thing worse. So I go back to what I said at the start of the programme. The bonds don't work, they just make things worse. And that is true of the story so far over the last couple of months. And at least it goes back to something you and I were talking about. The risk this year It's not been in equities or credit. The risk this year has been in the risk-free asset, and that's something we're all struggling to get our hands around.
Especially because there are leveraged instruments that we haven't fully appreciated. At what point do you get margin calls?
Right.
And this, Tom, has been the concern, because if those prices go down, you have to post more collateral. What do? You sell the risk-free asset. It creates that spiral.
Exactly. This is David Goldman 101 from Bank of America in August of 2007. John, on the data, let's be quick. Sterling to new weakness this morning, 112 down to 110.38.
Euro as well, 97.53. Double-digit inflation in Germany this week. Double-digit CPI in the Eurozone this morning. Yields are lower elsewhere by 8 basis points, 370 on a 10-year. And equities just about holding on, Tom. Positive 0.25% on the S&P.
Holding on is the expertise of the chief investment strategist at Luthol. Jim Paulson recalibrates into fourth quarter with us this morning. What's the value of cash right now, Mr. Paulson?
It's nice to see cash, Tom, at least giving a positive yield of some merit, but I don't think it's the right asset to be in right now. I think things are pretty unsustainable at the moment, and it's all tied to policy officials raising rates. In this country, the 10-year yield is going straight north while commodity prices are collapsing, while inflation surprise index is falling, while the ISM price surveys from service and manufacturers are falling out of bed, while inflation expectations in the bond market, break-even rates are collapsing. The dollar is simply out of control, and the upside is a reflection of yields. And I think, something's got to change. It's gotten too extreme. And probably what changes is rates stop going up soon. And if that's the case, I think the stock market's going to have a good rip yet. And I don't think you'll be pleased by putting too much in cash. But having some in cash, it's nice to have a bond market that's yielding something and a cash market that's yielding something. It certainly gives asset allocators or just people, individuals, an opportunity to diversify some risks that they haven't had for quite some time. What's that call option you've got then, Jim, on a rip? What are you playing? Where are you sitting? What's the pocket of the market you want to be present in? Well, I think I look at this like coming out of a recession, Jonathan. I would look at early cycle stocks. My favorite sector is the consumer discretionary sector. I think it's the one sector that's been most harmed by inflation. It destroys not only their operations by squeezing their margins of the companies, but it destroys the confidence of their customer base. And so as inflation rolls over, I think those stocks come back to life. I'd also, look at growth stocks, particularly small cap growth. My favorite tilt would be towards small caps, which, by the way, have held up remarkably well in this last draft in the stock market here since August. And I think that I would have some exposure there. I also think that there's cyclicals beyond the consumer discretionary that probably play, like industrials and so forth. And I also think there could be a play on the dollar yet. I just think the dollar's too high, has got to come down. And I don't know if I'd have a broad-based international bet right now, but I would maybe in emerging markets, excluding China.
So, Jim, right now Nike shares down 11% in pre-market trading. A screaming buy?
No, I don't have any particular preference to Nike, Lisa.
I don't mean to put you on the spot. I know that you're viewing this from a more big picture sense, but I guess that the point that I was trying to make is what's the risk to the downside as you wait for the Fed to blink when the Fed's saying we're not going to blink and no, things are not breaking. It looks like actually financial stability is holding in just fine in the U.S.
I think we're getting really close to a blink, and it'll probably be forced. It could be that we get a really weak economic report. It could be that we get a really good inflation report. Probably more likely is something breaks. And you guys are bringing up things this morning that are starting to show some cracks in the foundation. And right now, if something breaks in the U.S. and it's a systemic problem, there's more downside risk in the stock market. But I think that the private balance sheets of the United States, both households and corporations, are very solid, and they're very liquid. And the banking industry is squeaky clean in this country, and the chance of a systemic balance sheet break here, I think, are low. So I think something breaks, but if it's not systemic, it will cause a pause in the tightening cycle across the globe, and that could be a really big positive here for the stock market.
Jim,
If I
that's
can
the
make
bit I
one
struggle
point,
with.
you know,
Can you make that final point, and then I'll come back to you? Just take the stage. You've got the stage.
okay, I just want to make one point that, you know, Powell seems bent on, you know, channeling his inner Volcker moment, and the entire Volcker moment that actually occurred in 80 to 81 there, when Paul Volcker took the funds rate from 9.5% in August, I think, to 20% by December. The stock market after that, 81, 82, fell by a total of 27%. And I think it's important to recognize we're already down 25% in this country already. So even if we're having a Powell moment, you know, it's interesting. Volcker had a Volcker moment after 15 years of runaway inflation in this country. The Powell Fed is wanting to do a Volcker moment after 15 months of high inflation. I don't think the two are comparable and don't need the same approach.
Hey, Jim, we'll continue this conversation another time. So we appreciate your thoughts. Incredibly constructive. The hope is there. Jim Paulson there of the Luthold Group. The issue that many people have with that view is, Tom, why is it bullish if the Fed stops because of financial stability concerns or a recession? Why is that bullish? And there is a difference between a Fed pause and the Fed cutting. Now, if you're going to tell me the Fed will pause, I think the right way to frame that is you're basically telling me the Fed's not going to be cutting interest rates in a recession. So the Fed's not cutting in a recession. Is that bullish?
It's original, is the word I would put. John, I'll say it as simply as I can. What always ends up happening is you impute permanent inflation and price change into the economy, and that's the price the middle class pays.
Futures right now.
The fancy people are protected.
Up a third of 1% on the S&P. Yields lower by 8 basis points from New York City. On radio, on TV, this is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. Hurricane Ian is taking aim at South Carolina. Storm's winds picked up to 85 miles an hour overnight, and it's expected to make landfall today north of the historic city of Charleston. Ian caused catastrophic damage in Florida, where it came ashore as one of the strongest hurricanes ever to hit the U.S. The storm flooded towns on both coasts and wiped out entire neighborhoods. An unknown number of people are still believed to be trapped in their homes. British Prime Minister Liz Truss won't change course on the government's unfunded tax cuts. That's following talks with the government's budget watchdog after a week of market turmoil. Bloomberg's learned that Chancellor Kwasi Kwarteng will stick to his plan of delivering a medium-term fiscal statement on November 23rd. In Brussels, European Union energy ministers have backed a package of measures to fix the natural gas crisis. They include a goal to reduce power consumption and agreeing to tap windfall profits of energy companies. Still, there's some frustration that more hasn't been done. Vladimir Putin is set today to annex parts of Ukraine that Russian troops control. That's after a referendum condemned by the United Nations and called a sham by President Biden. Russia plans to sign treaties to absorb the 4 Ukrainian regions. China has formally certified its homegrown aircraft to take on Boeing and Airbus. Certification for the C919 would typically mark the end of flight testing and paves the way for a plane maker to start deliveries. For now, the C919 will only be allowed to fly within China until it's certified by foreign regulators. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Lisa Mateo. This is Bloomberg.
If you look at the dots, it does look like the committee is expecting a fair amount of additional moves this year. I think that was digested by markets and does seem to be the right interpretation.
Another way you could put that is that the Federal Reserve just endorsed the sell-off of the equity market. That was Jim Bullard, the St. Louis Fed president, speaking at an event hosted by HSBC. President Mester spoke yesterday as well, Lisa, asked if a recession would change her plans to hike interest rates, and she essentially answered that question with no.
That seems to be the message pretty clearly across the board. Citigroup put this out this morning. We still think a soft landing looks unlikely in the U.S. Thus, the Fed will have to tighten conditions enough to lower the equity market. The Fed is basically confirming that view and saying that is part of it, and they are not backing away from a slowdown that it may cause.
That's the objective, for now at least. On the equity market, we're positive 0.25% on the S&P. On the Nasdaq 100, up around about a third. Yield still lower by 8 basis points, Tom. 3.7% is your yield on a 10-year.
Amid a large crowd, I believe, in Moscow, history in the making. This is Mr. Putin just walking through large gold doors, and he is speaking to the assembled on the annexation of Ukraine. An expert for us with great experience on this across the continent, Anne-Marie Horton from Washington this morning. Anne-Marie, Mr. Putin is selling this to the Russian people. Who's behind him on this? Is this the military behind him? Is it the quote-unquote far right? Or is it a nostalgia for a new Soviet Union?
It's him. He's behind this. He's making all of these decisions as he stands in the Kremlin at St. George's Hall there. You can see he's surrounded by Russian officials in his government, legislators in the Duma. But this is all Putin. This is something he had dreamed of doing. Many thought he would never do this, only because of the repercussions and the blowback the Russian economy would face, and especially given the fact that they spent 20 years trying to integrate themselves into the global financial markets. And he then went for it. And like he did in 2014, the annexation, he is doing it with these 4 regions. And we should note what Putin is laying claim to today in this speech right now is 15% of land in Ukraine. That is the biggest laying claim of occupation of land that we have seen since World War II. And the biggest question right now surrounding all of this is if Putin is selling this to the Russian people at the same time that independent polls are saying the mobilization effort is not working. These men do not want to go fight this war. You see a mass exodus of these reservists. But at the same time, the biggest question right now is if he is laying claim to these lands, does he mean that if they are attacked, which there's fighting right now in them, will he revert to using tactical nuclear weapons?
For those on radio, as Mr. Putin speaks, of course, the images of leaders of his operative cabinet, including Mr. Lavrov moments ago. Anne-Marie Horton, I look at where we are with Mr. Putin, and we must say, what is the response? It has echoes of 1938 and 1939. We learned lessons there. What can be the response of Secretary Blinken and the president?
Well, we already heard the president ask about this late last night, about these sham referendums. And he said, I want to make clear, the United States will never, and I think he repeated it 4 or 5 times, never, ever, ever, ever say that this is Russian territory. So you're going to hear a ton of that kind of rhetoric today, whether or not it's from the president. His national security advisor, Jake Sullivan, will be in the briefing room today. All the questions are going to be about this moment, what is happening right now in Russia and this land grab in Ukraine. And of course, from the Secretary of State, but they made it obviously very clear also that if Putin was to go into his nuclear arsenal, there would be consequences. But there is angst around the European countries, especially those that share a border with Russia. You think of Poland, and what they're concerned about is not even so much if Putin goes and uses nuclear weapons, but if there is an accident at, say, Zaporizhia, the biggest nuclear power plant in Europe, what does that mean for the areas surrounding Ukraine? And these countries are incredibly, incredibly nervous.
Anne-Marie, we've talked a lot about what people within Russia feel as this goes on, and it's gotten more fraught at this moment, especially with the conscription, or at least the calling up of reserve forces. Do you have any sense of what the pushback is like internally, of whether people are starting to say, this is going far awry?
Well, there is pushback. There are protests that happen, and then these people get dragged off to jail. And then you've seen this mass exodus, a brain drain, and also a drain of men that are of fighting age leaving the country. You saw an absolute spike in Google searches of how to get out of Russia. You're hearing stories of people just grabbing any last flight they possibly can. They're walking across borders over Estonia and into any place that is going to offer them refuge because they do not want to get that knock on the door. And you're also seeing this a huge issue in countries like Georgia and Kazakhstan because they're having these buildup on their borders of people trying to leave. So in terms of morale of this mobilization, it is not there. And part of the reason is because Putin just months ago promised the Russian people there would be no conscription. And then yet once again, he's lied.
AMH, you're in a class of your own. We're lucky to have you. Thanks for being with us. Anne-Marie Hordern there, down in Washington, D.C. Russia's leader saying the documents on annexation, Tom, will be signed today as we wait for that speech to begin and the headlines that will come from it.
I talked, John, of a 2022. As I mentioned at the top of the show, I ran into Gideon Rose yesterday, and, in laughter, I blamed him for this 2022. But this international relations, John, is moving in real time. And I don't have any punditry to add to it other than we need to apply our acutest minds to it across many fronts.
As Europe grapples with an energy crisis, at least with no end in sight. We're talking about this winter. We're talking much more now, I think, and Jeff Curry said it, about the winter after that and the one after that.
And I wonder how much the U.S. can really step up and provide them with what they're looking for, or Norway. I mean, where are the other sources going to come from? Post-2022, there is going to be a complete rearranging of the energy dominance, really, of the nations that really have the clout in the energy sphere, and it's unclear what it's going to look like. But Russia apparently seems to be excluded from that, and not just with respect to oil and gas, but also with respect even to steel and some of the other commodities as people try to figure out how to get around turning to them.
Coming up on this program, Tom Porcelli, the chief U.S. economist at RBC Capital Markets, and his latest note, his daily check. There is a saying in economics that we live in a nominal world. That may be true, but economics is graded in real terms. Tom Porcelli is going to be joining us very, very shortly. Equities up 0.2% on the S&P. On the Nasdaq, Tom, up 0.2% as well.
Is Porcelli doing the real yield this afternoon?
He doesn't know yet. He's joining with Laurie Calvasina. They're both going to join me. We're doing an RBC special. Halima Croft dropping by too. None of the people at RBC know about this.
They're going to do it alone. They're just going to come on and they're going to come on and do it themselves.
Lisa doesn't know she's hosting it. Tom doesn't know he's on it. From
Sounds
New York.
Great.
This is Bloomberg. Live from New York City this morning. Good morning. Fascinating headlines coming out of Russia at the moment. The Russian leader signing documents on annexation today. Going on to say this, the collapse of the Soviet Union was a national catastrophe. We've heard that from Putin earlier this year. Russia is not seeking to restore the Soviet Union, calling on Ukraine to stop fighting and start talks. Won't discuss the results of the referendums with Kyiv. Will defend our lands with all available means. Russia won't negotiate about annexed territories. That line, Tom, I wonder how that's going to be received by the Ukrainians a little bit later.
I saw a headline earlier this week, and that the Ukrainian take, and I'm making this up as I go, folks, was they won't negotiate with Mr. Putin. They want to see somebody else to talk to. Well, that was a number of days ago, which, John, is forever ago. But I would just respectfully suggest this is history in the making. We're seeing right now, I believe Ms. Hordern said this is 11%, 18% of territory.
Shocking. Just shocking, Tom. Just like that. I want to get you some data as well. The PCE deflator month on month comes in hotter. 0.3% for August. Year over year, 6.2. We were looking for 6% year over year, month on month. Lisa, we were looking for 0.1. I'll bring the core to the audience as well. PCE core in at 0.6. Up from 0.1, that's month over month. Year over year, 4.9 year over year. That's up from a revised number of 4.7. Your thoughts, Bramo?
Exactly what the Fed does not want to see, kind of like the unemployment numbers yesterday, which are good for the economy, but bad for the Fed because it's moving away from them. Basically, you're seeing a stickiness in the core inflation metric that they watch most closely. And you can see that the reaction is downward when it comes to stocks and bond yields ticking up just a little bit on the front end. But you've got to wonder how much this really does challenge people who think the Fed can afford to pause, can afford to say, we're going to see the weakness trickle through, because you're not seeing that when you take a look at the core inflation data.
The conflict in policy, and well said, Lisa, this week is just humongous. They're chasing their tails, emboldened by a lagging indicator in the labour market. Claims are still sub 200k. Tom, inflation's still hot, and financial stability risk is bubbling away in the background, to the point that the Bank of England had to intervene earlier this week.
Yeah, well, that's a derivative story that's unfolding this weekend, and I would look for every single responsible general counsel to say, John, let's get the news out right now, worldwide, on the continent, in the United States, anybody doing this LDI derivative strategy as well. Let's march forward here. We've got an extremely busy, important half hour. John, what's your number one guest in the next hour? Let's sell the 9 a.m.
Mohammed Al-Arian, top of the show.
He's going to show up again.
In
Wonderful.
the A block. Going to catch up with Mohammed. We'll catch up with Matt Hornback
I don't know
as
what
well.
that is.
Going to catch up with Jill Carey Hall of B of A, Julian Emmanuel of Evercore.
Julian.
Got more guests. Going to keep going through them.
As
I
well.
haven't. That's it.
Al-Arian never wants to talk to me. I don't know what that's about. I mean, it has, I insulted Queens Park Rangers one time.
And that was it.
That was it.
That was it.
Right now, Thomas Purcelli with us, chief U.S. economist. Again, Matthew, please. Okay, we've got a technical difficulty here right now with Mr. Purcelli. John, I was going to go to Mr. Purcelli's wheelhouse, which is wage analysis among an America with claims of under 220,000 as well. You wonder what wage dynamics do here amid slow productivity.
I can give you a tease of Tom Purcelli if you like, and I'll just read you his latest note. So I read the first couple of lines.
You read his
this.
notes. I didn't read his notes.
I read the note. There is a saying in economics that we live in a nominal world. That may be true, but economics is graded in real terms, meaning inflation adjusted. The next line, Lisa, reads as follows. What we know right now is that the volume of goods in spending, i.e. in real terms, has been and continues sinking.
Well, and this is what some people have been saying, that you are seeing people spend on services, but that's the reason why you're seeing the likes of Nike, for example, or many other companies seeing inventories build because people are not spending. And he is basically making the argument, as are other people, you're seeing a lot more softening. And this was Jim Pulse's argument. The Fed doesn't have to be as aggressive. It will take hold. You will see a natural effect kind of play into it if Tom say you expand out the x-axis. Still, though, what's the other side of that? Especially, these are uncharted territories.
I think the point that people are asking right now is that the labour market, the headline indicators, jobless claims, all of the above, still look rock solid. And if the Fed is waiting for that to break before they back off, do they risk waiting too long? What Purcelli ultimately ends up saying is that we have said that job losses, when they materialise, are likely to be relatively modest. But what if earnings get really dinged up here on the fact that the volume of spending, Tom, is declining and maybe gets worse as central banks around the world slam on the brakes? It seems pretty clear that net value add would just get worse from here. That's the conclusion, Tom, from Tom and the team at RBC.
In an event as we move into the fourth quarter of this year, an attempt to recalibrate. Tom Purcelli now joins us with RBC Capital Markets. It's the oddest thing, Tom. This wasn't in the textbooks at Binghamton. It wasn't in the textbooks at Columbia. How do we have this tumult and yet claims showing a fully employed America?
So let me first start by saying, Jonathan, honestly, like I'm happy just to sit by and listen to you speak my words. Like they sound beautiful.
That's the act.
You.
I can do the podcast, Tom, if you want to hire me. I'll do the podcast. You have to pay me by the word.
And I can do that. I mean, I don't know who wouldn't do that for you. And I will also say to you, Jonathan, I am waiting for my invite to the Real Yield.
We've got to make that happen, Tom.
I love that Lori's going to be on. She's one of my favorites. So one day I'm just going to be waiting here for that invite.
You can take the call anytime. Tom, the point that you're making, though, I think is a really important one. So allow me to reframe it from my perspective. Are you essentially saying that this Fed's going to be emboldened by labour market data that's not going to move too much and they just risk going too far?
Yeah, I think that's exactly what's happening. I mean, look, we all get the sort of. Don't you guys find it interesting that when people talk about the labor market and how robust they think it is, they always default back to the payroll report, right? When most other labor data have deteriorated, even jobless claims. Look, I get it. It's great that they've scaled back. They're still up off the lows. They're up 20% off the lows. I mean, the movement is what matters. Even if you look at something like the labor differential. From the Conference Board. I mean, that has deteriorated. And by the way, the proof in the pudding on that is just look at average weekly earnings. I've said this to you all before. It's slowing. It's starting the process of slowing. You're running at a near 7% pace. Now you're at 3.5% pace. I mean, there are indications that the labor market is starting the process of deteriorating. And seemingly on a pretty regular basis, we get companies that say they're either freezing hiring or they're going to start laying people off. And the point in that note, Jonathan, that I put out the other day was exactly this. It's, at some point, companies are going to... So if you look at profits, right, profits in real terms, I mean, it's funny to me that people have a hard time with this. I don't know why. Profits in real terms are flat. And nominally, they're running at a 13 or 15% pace. And I guess people take some comfort in that. But adjusted for inflation, they're flat. And if we're right that the volume of spending continues to slow, and actually, let me be clear, not even slow, it's falling. What do you think is going to happen to earnings? And when that shows up, if profits are already flat and earnings and the volume of spending is down, that means we know the direction that profits are going. How do you think companies are going to defend profit margins? That's all waiting for us. So the Fed can continue to look at the landscape today and say, hey, we feel really comfortable raising rates, but it's deteriorating now.
Tom,
sorry, Lisa.
No, I appreciate what you're saying, and you're talking about how the labor market's a lagging indicator, or might not even show the pain to the degree that other aspects of the market. But it doesn't feel like the Fed is really paying attention to earnings. They're not paying attention to certain stock market metrics, except to the fact that they perhaps would like to see the stock market go down. If you look at some of the members of the Federal Reserve, however, they are looking at inflation. Can you see a case where inflation is still high, the employment market is not showing a real deterioration, but you could still make an argument that the Fed should pause or even lower rates?
Yeah, so I love this question, Lisa, and I think what we need to, it's fun. On some level, I was just talking to a buddy about this the other day. Like on some level, I would love for like Powell or someone to come out and say, hey, we're just cleaning up the mess made by fiscal policy, right? I mean, because that's a really important idea in that, why did we generate this inflationary impulse, right? I mean, at a base level, we shut down a really healthy economy. We gave people a lot of money, creating a pent-up demand scenario. We then turned the economy back on like a light switch, and we dared these people to go spend, all in the context of supply problems. I mean, what did we think was going to happen from an inflation perspective? But here's the thing. Once we burn off a lot of that pent-up demand, and once we burn off a lot of that fiscal stimulus that was put in place, and you have this deteriorating labor market that we were just talking about, it's really easy to see a case where inflationary pressure can actually start the process of easing, and that's what we expect will happen in 23.
Tom Porcelli with a big call at the end there from RBC. Tom, we're going to continue this conversation another time. Tom Porcelli there on the latest. Lisa, interesting thoughts, eh? It's something that's been talked about a fair bit, that maybe they are emboldened by a lagging indicator that ultimately is not going to leave too much pace. Here's the question I would ask, and someone smarter than me said it yesterday. You can't fire what you can't hire. And a big struggle over the last couple of years has been hiring enough people. So what have we seen from the big tech players, the likes of Facebook, Meta, if you want to use that word? They're freezing hiring. They couldn't meet the headcount anyway because they couldn't find the people, and so many people are in that place. So I wonder what this labour market downturn, if we get one, actually looks like.
It's a great point, and you're seeing this also with the likes of Amazon.com raising salaries to keep attracting people, even though things are slowing, right? So there is this divergence between what a fully employed America looks like and what a fully employed corporate America looks like, and the prospect of a downturn. At the same time, let's be clear, the Fed is not just looking at the employment market. They are also looking at inflation. And if inflation remains high, it is very hard to make an argument that they can keep their foot off the brakes to try to really fight it.
Coming up in the next hour, we'll have this conversation with Mohammed Al-Arian of Queen's College, Cambridge, Jill Carey-Hall of Bank of America, Matt Hornback of Morgan Stanley, Julian Emanuel Evercore, and Marko Kolanovic will not take my call. Marko just won't take my call. Going to keep trying.
We'll stick him in there.
And trying. He doesn't know he's coming on later. He's not.
He's earning the real yield.
He's not. Futures unchanged on the S&P from New York. This is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. Hurricane Ian's winds have picked up speed and the storm's on a path to hit South Carolina. The forecast calls for Ian to come ashore north of Charleston today with heavy rain and a potentially deadly storm surge. Florida is struggling to recover after Ian made landfall as one of the strongest hurricanes ever in the U.S. Entire communities were wiped out and homes were flooded on both coasts of the state. An exact death toll has not been confirmed. Vladimir Putin is speaking on the annexation of parts of Ukraine that Russian troops control. He says he won't negotiate the annexed territories, and he called on Ukraine to stop fighting and start peace talks. Russia held referendums in the 4 regions being annexed. Those votes were condemned by the UN and called a sham by President Biden. There's more pressure on the European Central Bank to keep raising interest rates aggressively. The Eurozone has just recorded its first ever reading of double-digit inflation. Consumer prices rose 10% in September from a year ago. That's the 5th straight month that the inflation figure has exceeded the consensus estimate. And new car sales in the U.S. are expected to rise in the 3rd quarter, but a deteriorating market for used cars suggests there's trouble ahead for automakers. The resale market often indicates where new car demand is headed, and used car giant CarMax says vehicle sales dropped 10% in the 3 months that ended in August. And shares of Nike, they're lower today. The sports shoe giant reported that inventory has surged, and it's hard to push through discounts that have hurt profitability. Higher freight costs, markdowns, and foreign exchange effects hurt Nike's gross margin in the last quarter. Well, global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts. I'm Lisa Mateo. This is Bloomberg.
These price caps are going to reduce inflation. This is an illusion, right? Because what these things do is they increase the demand for energy and therefore increase wholesale prices, and somebody's eventually going to have to pay for that.
The dynamics of Christian Schulz, Citi Deputy Chief Economist, as Vladimir Putin continues his discussion in Moscow on the annexation of Ukraine. Of course, folding into hydrocarbon analysis, West Texas trying to get to a 79, 80.74, Brent flat, 88.60. We began our show this morning with a blistering conversation with a representative of the Trust government. Thank you for your comments worldwide, and particularly from the United Kingdom. Now, Lisa Abramowicz and I close out with someone expert on derivative certitude and derivative damage, Marcus Ashworth, with decades of experience like me in this. Marcus, I want to go to Nomura and Hyman's Nicholson in 2018. They absolutely nailed this. They called it peak LDI. Pension funds have been adding $100 kajillion of all-in derivative exposure a year. Given the high level of hedging, the current pace of rate hedging can only continue for at least another 3 years. We are approaching peak LDI. We know this. You knew this at Manchester in economics a million years ago, Marcus. I know it. We experienced it in 07, 08. Why are we screwing up derivative certitude once again?
Well, there's just direction of travel from the regulators is the simple answer. It's not fair on the regulator, maybe, but certainly both pension trustees, indeed now poor pensioners, are feeling the pressure of the way the actuarial rules work in the UK, forcing pension funds essentially to take ever more fixed income protection if rates go down. The irony is that if interest rates rise, if yields rise slowly and calmly, that means there's less requirement to own bonds because they can make up whatever their pension liability is going to be much better. The point is, it was a too sharp a move, and the collateral, the plumbing, has got bunged up. Everyone scrambled to basically sell gilt.
Do you think there's more events this afternoon into the weekend, or people that have to admit Monday or Tuesday they're in the same boat?
I think, look, I'm going to be bold here and say this crisis is largely over. It's a very nasty moment. The Bank of England stepped in, solved it. They're going to continue to be around for the next 2 weeks. If you actually look at the take-up of what's coming through, it's only about $2.5 billion so far. This is not the 65 billion number getting floated around. That's the maximum. It won't be anything like that. I think what we need to do is maybe sort out the over leverage, particularly into the LDI system. Yeah. The system itself can work but not to the extremities and the leverage which they've been putting it through.
And Lisa, that harkens to 1998, the dreaded L word, and it's not liability, it's leverage.
And that's where I wanted to go. This question of full faith and credit, risk-free assets being pledged as collateral and then suddenly not being risk-free and being the epicenter of losses and forcing sales of risk-free assets to post more collateral, creating that spiral. Are there any other places in the financial system away from the United Kingdom where that looks like it could become a problem should the losses in the bond market become severe or sudden enough?
I mean, absolutely. I mean, I think Germany has already moved, as has Austria, to essentially repo squeeze and make it very difficult to borrow bunds. And that is essentially what's happened in the UK. The reason why we're seeing a recovery in the gilt market in the last couple of days, and quite a strong one, is because, ironically, the repo system has tightened up. You can't borrow gilts to short. So, you know, beware of perhaps a little bit of settling. Next week, when we get, you know, into the new quarter, a new month and what have you, there may be a second go at this, but the Bank of England's there for the next couple of weeks. It should be fine. I think people understand that the immediate crisis is over, but we do have a longer term problem about exposure with that. But yes, there's a real problem to the US Treasury market. You know, in any swap counterparty which has post collateral, they can't borrow risk-free assets. It's very difficult. And that's something which we have to have a careful look at, both in Europe and very much in the US as well.
Meanwhile, there's a more traditional leverage that is of growing concern as well, which is companies that have borrowed money and need to refinance and find themselves either locked out of a market or prohibitively expensive to refinance. You're seeing that in Europe even more than in the United States. How concerned are you about the rise of credit risk perceived and the inability to refinance in certain pockets in Europe?
Well, what can I say? They've had 2 long years to drink heavily at the trough of free money, often negative money, certainly for governments and even for the odd corporate. If they haven't got their financing in order by now, then they shouldn't be in business. And that's the problem. A lot of these companies, if they are going to bang, they should have been in business in the first place. There needs to be a bit of credit destruction. But I don't see a major problem in defaults in Europe either. I don't think there's a huge issue here. It will get tight for some. There will be some liquidity issues, as there always is and there always should be. What we've got to move away from is the zero rate mentality and nothing can ever go bust. Because long term, that's what's causing a much bigger problem, which could go bang, as we can see with the sensitivity in derivative markets. The plumbing can get bunged up real quick, and yes, it will squeeze a few people trying to get mortgages, or the odd corporate who's got its financing schedule slightly out of whack. But look, if they need to borrow, they have to pay up. That's the market.
I got 8 ways to go here. Marcus Ashworth, brilliant as always. Thank you so much with Bloomberg Opinion and writing on his disunited kingdom. Lisa, literally, I got 14 ways to go to close out the hour. And what I would suggest is, boy, we have a lot of data next week. I mean, we're going to be, where are we a week from this moment? At 8:53, 20 minutes after the jobs report.
We got 2 data points this week. And we got 2 data points that both point to saying the Fed has more work to do. It's not the message that they want to hear. We saw jobless claims that came in lower than expected. We saw a core PCE deflator, a key inflation metric, come in hotter than expected. Both of these seeming to signal there are some problems here, and Fed speakers coming out and saying a slowdown won't cut it. And this goes to the Tom Porcelli point. They want labor market destruction to some degree, and they want to see inflation come down. They're not seeing either of those things, which really poses a huge problem for them.
It's just fascinating the moment we're in at the end of this third quarter, and I can tell you I did not expect this at the end of the second quarter as well. On the derivative mess, Lisa, is just something we have to read about. I went back and looked at YouTube videos of marketing efforts for liability-driven swaps trades from 2 years ago, 4 years ago, 5 years ago, and they're charming in their marketing certitude. I mean, this is a huge, embarrassing story, again, for the derivative business. Once again, take Buffett, the water went out and a few people aren't wearing swimsuits.
And it's the conundrum when you have risk and risk-free assets, when suddenly the instruments you've posted as collateral are the same instruments that you have to sell to raise more collateral, creating a price spiral in one of the main mechanisms of the global financial markets.
Major shout out to Team Surveillance this weekend, who day after day blew up the show to give you the best voices we can on the global, the American ramifications of what's going on in the United Kingdom, with futures up 7. And, febrile seems to be the word of the week. I'll go with it. There's just a churn to the market right now. Sterling with a little bit of a lift, 110.74. Please stay with us through this historic day, including reports on Mr. Putin and Russia. This is Bloomberg. Good morning.